The things that have been driving the market over the last couple of years have now switched over.
It's no longer, we're just going to take at face value the AI trade.
We are very heartened by the embracer of this rotation.
We think it's a stock picker's market, so you got to be selective.
There's plenty of opportunity globally to diversify.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, it's CPI Friday. As major tech jitters are consuming investors worldwide, risk aversion is sending bond yields sinking to new lows for 26, just before we get another read on price pressure in America. We begin this hour taking stock of another wild week on Wall Street. Just 2% from all-time highs, and yet in some sectors, it already feels like a bear market. Wave after wave of anxiety crashing through industry groups, from software to wealth management, from real estate to logistics. Not even a much stronger than expected jobs report enough to lift the mood. Investors dropping the banks and piling into staples, sending Walmart to fresh record highs as investors look for somewhere to hide.
So how do you hide from an existential AI threat that, as Joe Amato yesterday of Neuberger Berman said, is like a heat-seeking missile looking for its next target? You buy toilet paper, you buy bananas and string cheese and wheat thins. You go out there, you buy a tinfoil hat or maybe just some of the metals that you've got, which is the reason why staples are doing so well right now. There is a feeling that even if some of these moves are overdone, we do not understand the scope and the speed of the disruption that is happening right before us.
Overdone at 50 PE on Walmart. Yep, maybe overdone. We can talk about that a little bit later. Let's talk about the headlines. You've all seen them online, on X. It's February 2020. We were talking about that yesterday. It's 2008, yet this time the software names, they're the banks. And then you hear this from the Microsoft AI chief to the Financial Times. As for white-collar work, quote, most of those tasks will be fully automated by an AI within the next 12 to 18 months. Is that a warning or a sales pitch? You decide, a warning or a sales pitch. This from Anthropic yesterday. Completing a deal to raise $30 billion in funding from investors at a $380 billion valuation.
Look, it could be both. And I think the problem is that the market can't decipher which it is, because ultimately there has been an unproven aspect to what we have seen from some of these artificial intelligence and large language models. If you talk to some people who have been intimately connected to some of the crafting of these models, they do say that the speed has been dramatic and has been profound, and it will change jobs. Pinterest cutting a significant swath of their employees because they are leaning into AI-related tools rather than the random person who is putting different images on their page. So you do see this starting to affect the business models of a whole host of companies. That's true. On the other side, will it eradicate humanity as we know it? Probably that is more of the marketing pitch as Anthropic raises $30 billion.
There is a great contradiction, I think, in the price action of the last week or so. And here it is, that somehow this tech is going to be so highly disruptive it will destroy everything, and yet still the capex is a waste of money. Can you square that circle? Can you have both at the same time?
No, because ultimately someone's got to win. The profits have to be there. The only way to square that circle is recession. The only way to square that circle is if suddenly the whole concept of a new technology that undermines the reason for our existence in various jobs really does create some sort of dramatic drawdown in the overall economic growth that leads to a problem. If that's the case, well, then why are we even going into this in the first place? So it does kind of undermine some of these capex plans. So to your point, there's got to be a payoff somewhere, and you're starting to see it. A number of companies that are saying, look, our efficiency is so much higher. Our profitability is so much higher. That said, the fly in the ointment, as Torsten Slocks has pointed out many times, is that the profitability has been directed toward a small cohort of tech-dominated stocks. It has not broadened out yet, and that, I think, is going to be the key tell in earnings for the rest of this year.
This is also super frustrating for so many investors right now. Only 2 weeks ago, it was a cyclical rotation. Global risk appetite's picking up, and you could see that across small caps, across banks. Now look at how things are playing out. Look at the sector performance. Banks this week down 6%. Staples up by 1 to 2%. Walmart, all-time highs. If you took a step back and knew nothing about the technology story, the software disruption, and just saw that sector performance, that's the recession trade. Bond yields at new lows for the year.
Yeah, if you take a look at what's going on, it's both recession trade and a complete loss of liquidity. This is a market that feels like it's being jerked around by funds that are getting blown out and stopped out and having to liquidate gold in order to cover their losses. Why would gold be down in this kind of trade if this is a recession trade? Look, this feels like a highly financialized market that is losing losing its liquidity base. And right now, there is thin confidence and there's thin trading. And that's what you see in these wild whip swings. I mean, why is Cisco down 12.5%? Because its margins are a minuscule smidge smaller than people had expected when they overperform on sales. I mean, it just does not make sense from any traditional backdrop.
And yet the stock market is 2% away from all-time highs on the S&P 500. Futures this morning down another 0.25%. Coming up this hour, we'll catch up with Tchir of Academy Securities, with AI fears keeping Wall Street very much on edge. Thom Forte of Maxim Group, with Apple bearing the brunt of the mega-cap sell-off. And Andrew Hollenhorst of Citi looking ahead to a fresh read on inflation. We begin this hour with stocks on course for back-to-back weekly losses. Tchir of Academy writing the following: we're transitioning on multiple fronts, and that transition will create some volatility. Pete joins us now for more. Pete, good morning. This is quite a transition. How would you describe this transition to clients at the moment?
You know, I think, one, at the world order sort of level, we went from this kind of rules-based economy where we kind of understood the rules. China, I think, was pressing the envelope, and we've now thrown a bunch of Molotov cocktails there. We are going to wind up, I think, in potentially another stable system where everyone does a little bit more on their own. Global trade kind of diminishes, and each country becomes a little bit more responsible for their own efforts. But that's a stable state, and we're in a stable state. I think the transition is very painful. We're going through that. I think we're seeing some of the same transitions in AI. How's it going to be applied? Where is this going to be used? So when I'm looking at the AI story right now, I think what you want to avoid is companies that don't rely on people, don't rely on property, plant, and equipment, and have very high margins. I think that's where you can see AI disrupt, right? It's easy to disrupt those kind of tech sort of earnings, right? Okay, they're not going to replace the big tech companies, but if products come along that are cheaper, you start feeling that margin pressure. At the end of it, I think companies that are actually producing things, goods, services, real things, tangible, you know, pulling things out of the ground, those companies are going to do well, and that's where you might see margin, you know, increases. So we've had this tail of a tape, right, where we've had low margin companies, high margin. I think that's going to dissipate, and you're going to see the pressure on those high margin companies as they feel it, and you're actually going to see continued rallies in the other sectors.
Pete, here's the issue. Some people thought the safety play was trucking, the movement of physical goods, and then yesterday happened.
You know, one, I think Lisa mentioned one of my favorite points has been this lack of liquidity. I think we live in this world of what we've been calling faux liquidity, right? There's all these algos, they're all sitting there trying to make markets, but when a trade starts happening, it accelerates, right? There is no real depth. There's no one sitting there really willing to pick up and say, I'm going to step in the middle of this, and you create all these stop losses. So the hedge funds all have the stop loss trading, CTAs have stop loss trading. People see this too. Now they can use whether it's single stock leveraged ETFs, whether it's some index leveraged ETFs, they apply onto 0 day to expiration options. So I think you kind of see this additional pull on things.
There's a signal, though, for a karaoke company turned into somehow a trucking and logistics company overnight with less than $2 million of sales at the quarter ended September 30th, coming out and saying, look what we have, and then suddenly having trucking stocks plunge 14.5% in response. Isn't there a tell about what risk appetite is and how much the fear is out there, the trigger finger that so many people have?
Definitely. I think people are looking for excuses, and it doesn't take much. And at the same time, I do track some of this. I'm going to say this, and I think it started with Greenland, right? I think we've now shifted this world where the U.S. is not friends with everyone, and every other country kind of realizes.
You keep going back to geopolitics. I'm surprised by that. The first question I had for you, I thought that Pete was going to be talking about tech next.
Completely. I was actually just going to say the same thing.
And geopolitics. Why do you keep doing that? Why is that important?
Because it is the biggest driver out there. What we're doing with China is going to affect our outcomes. I think we're trying to do a lot of things on rare earth critical minerals, electricity production. China's doing that, and the rest of the world's now confused, right? I think pre-Denmark, okay, we're all trying to figure out how to deal with what's going on with this administration, and I think that slapping the tariffs on Europe kind of randomly, and again, as far as I can tell, there was not a single ask ever, Greenland, do this for us, and Greenland said no. All of a sudden, it was take over, and then just this past week, you look at the, I'm going to probably title the report, A Bridge Too Far. I think the messaging that came across on the Ambassador Bridge, what we're doing, and I've had to go over that old bridge, it's awful, and I grew up in Canada, I am Canadian, so take this all with a grain of salt, but I think the messaging was just very unclear. It clearly affects Michigan, which is a swing state, so I'm wondering if some of this trade is too, we felt we were on this path. We saw what Trump was doing. I think, when we took Maduro out, that was an extremely successful operation. There was success, and since then, I think we're losing faith in this, and you want to invest in other countries because everyone's doing their own thing right now.
There have been so many people who have come on the show, and I'm glad that John pointed this out because I was thinking the same thing, who have said geopolitics matter in the long term, but in the short term, that's not what's jerking around price action. This isn't what people are following on a day-to-day. Yesterday, people were looking at a karaoke company. They weren't looking at Greenland. Why is this structurally different where suddenly that is going to inject more volatility at a time where the marginal flows seem to be on the margins heading away from the United States? I mean, is there something about flows that affects both the liquidity and the market reaction as a result of this changing geopolitical order?
Yeah, I think two things. One is, if you're in Germany today and you're going to the store, is a U.S. brand as appealing as a German brand now as it was 3 months ago, 6 months ago, a year ago, right? I think we rely heavily on selling to foreign countries, right? If you're an American company trying to get a meeting in Europe, is it as easy today as it was 6 months ago? I think that's changing, right? There's been a pullback, and I think it's going to affect our foreign sales. I think it's going to do a lot of those things. I think it's affecting a bit on foreign capital. Again, look at the banks, right? Maybe that's part of this, right? If we're decoupling a little bit, that gives less opportunity for U.S. banks maybe than we had 6 months ago or 3 months ago. So I think these geopolitical ramifications are coming through. And, there were some tweets I saw, maybe coming in that China and Trump said something. No one even seems to care anymore. I think we've moved past that.
Pete, you think that this is a short on White House policy?
I think there's an element of that. One thing I keep watching is Bitcoin. Like, it cannot get up. And there's been nothing but good news about Bitcoin, right? Everything goes, there's been some delays, but all the things this administration is doing is towards Bitcoin, and it's still struggling right around 67,000. And to me, that's telling me there's something going on that's affecting people's investment behavior. 2 months ago, 6 months ago, a year ago, certainly everyone would have piled into those sorts of trades. Are they out of money? I look at TQQQ, which is the triple leverage Qs. It's not really experiencing big inflows. Last year when we were going through Liberation Day and you had to buy the dip, massive inflows into that. ARKK, which is kind of like a disruptive, same thing.
So I see John's face, and I see that face across Wall Street to a lot of people who are listening to this. Really? We're talking about Greenland this morning. We're talking about all of this geopolitics. When we're talking about huge CTA funds that are whipsawing their money on AI fears. Is there something bigger here? And this is where I'm wondering if there's actually a connector. Because flows have been moving away from the United States, or on the margins, there's been a much bigger flow of cash going into Europe as well as Japan and China. Is that creating a less liquid backdrop? I mean, is that kind of what we're seeing right now, John? I mean, that's sort of, to me, maybe the way to connect these two.
Where's the leverage, Pete? Where do you think it is?
I do think it's in, call it the degen trade still, where people are still very aggressively positioned in these leveraged, ETFs. There's still a decent amount of size. Every day it seems like there's 5 or 10 new single stock leveraged ETFs. You've seen the crypto. I think there's a lot, and gold and silver became hot things. I think all those things kind of have to get pushed down and renormalized, right? Again, it seemed like every day someone would come on and say debasement, and we should buy gold because debasement, and no one's explaining where the debasement's coming. Like, where is the debasement? So we get ahead of ourselves, and I think everything's kind of pushed by the stop-loss trading on both directions. And no one complains when we're going up every day, right? Oh, that's just fine. That's because I was super smart. I made these great picks. And
that's always the way.
But there's the same liquidity issues. It goes in both directions. It tends to be slower on the upside and much more rapid on the downside.
Is there a cyclical signal in the sector price action this week or not?
Yeah, I think we are changing the dynamic of, the global economy, and people are going to have to look a little bit differently within that. I think there are going to be some concerns about how U.S. companies do in sales. On the flip side of that, though, I do think all those things we've been talking about, production for security, whether it's biotech, whether it's electricity, those things are going to stay through this administration. They're going to be developed, and they're getting developed everywhere. Like, I love uranium still, for example. I don't see a world that doesn't realize they need nuclear anymore. And that's happening. You're starting seeing in Canada. Again, I think that's the flip side of some of this, too, is you even looked at Canada. All of a sudden, they're trying to actually process and refine some of their resources. They're no longer just content to sell them. Everyone seems to be turning to China, who, maybe it's the least dirty shirt when you look at this. Like, at least China tells you what they're going to do. They wrote this thing, China 2025. They're going to control the world in this, and this. They did it. But I think as people are trying to look, who do you trade with? How do you do business relationships when it seems like every day, if you thought you had a deal, that deal could be changed? And that's becoming, I think, increasingly difficult. And the other part of this is we always looked at tariffs, right? And it's, say, $30 billion a month. I always argued that it was going to take time for this to have a cumulative effect. Well, it's now been 7-8 months, so now we're at $250 billion. I also, this will be very simplistic, and anyone who's truly looking at companies will laugh at me, but I just, as a working assumption, let's say everyone does 2 turns of inventory, right? So if everyone kind of knew tariffs were coming and it was a risk, they had 6 months, maybe 9 months of supply. It's only now that every company is starting to be fully engaged in tariffs, and people have been very reluctant, certainly early on, to pass these on because it was catching the, it would cause you problems. I think these things are getting passed on more and more, and all these things are coming home to roost. And it's just, there's a very, you look at delinquencies on everything across the board, there is some mess, one positive to say, because now I feel like I've been too negative, that we've been really excited about. I think you're seeing a regrowth in the Great Lakes regions. I think you're seeing some of these states that have kind of like fell behind a little bit.
Yeah.
Access to fresh water is huge. It is going to be a huge part of any sort of industrial revolution that we do. We're doing that. I'm hearing some chatter now that we might pull back on tariffs on steel and aluminum, which would make sense. I think I tweeted at the time we were doing this, we're tariffing everything that we need to actually build out industry, which made no sense. So maybe we'll have a policy that's a little bit more coordinated and gets that growth. But I think it's going to be those hard physical assets that do best.
We'll let you take a break because you started interviewing yourself. Pete, you're going to stick with us. Tchir of Academy. Pete, thank you. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Is Vonnie Quinn. Hey, Vonnie.
Hey, good morning, John. Hi. Venezuela planning to grant more oil production land to Chevron and Repsol. Sources are telling us here at Bloomberg that officials in Caracas are preparing to award the exploration and production blocks as soon as this week. U.S. Energy Secretary Chris Wright toured a project operated by Chevron in Venezuela's oil wells. The Trump administration is working to narrow its scope on some metal tariffs. Sources telling us here at Bloomberg that change would target levies on steel and aluminum products that many companies find difficult to calculate and that negatively impact consumers. The report is sending London aluminum prices lower today. Anthropic completing that $30 billion funding deal from investors, including Singapore's sovereign wealth fund GIC and Cotu Management. The deal values the AI company at $380 billion. Anthropic also confirming plans to let employees sell shares in the company at the same valuation as this latest round. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. We'll see you later this hour. Up next on the programme, Seek and Destroy.
AI has been sort of like a heat-seeking missile, looking at different sectors in the equity markets. You know, first it was software, then it was private credit, then it's data service providers.
And now it's logistics. Mandeep Singh of Bloomberg. Up next from New York City this morning. Good morning. Next up, inflation in America. The CPI report about 2 hours away. Looking ahead to that at 8:30 Eastern Time. Going into it, the scores look like this. Equity futures pulling back by 1/3% on the S&P 500, on the Nasdaq down by 1/3%. Also, in the bond market, if I showed you ISM and payrolls, you'd conclude things were pretty good right now. But any counterpoint whatsoever, including jobless claims, test the theory. Test the bull case. Yields near the lows of the year, 4.1134 on 10s.
People had so many notes overnight about all of the reasons why the strong payrolls report wasn't that strong. I mean, I did not read one saying, oh my goodness, you look under the hood and it's actually stronger than people thought. And ultimately this goes down to A, skepticism about the integrity of some of the data, not from any kind of conspiracy theory, but just because of some of the seasonal changes. And B, the lack of signal at a time where there's not wide breadth of some of this job creation.
The tech anxiety is overwhelming for the jobs market as well. Under surveillance this morning, Seek and Destroy.
The things that have been driving the market over the last couple of years have now switched over. AI has been sort of like a heat-seeking missile, looking at different sectors in the equity markets. You know, first it was software, then it was private credit, then it's data service providers. AI is going to be the most massive creative destruction process we've ever seen, and it's going to be happening faster than we've ever seen it.
So here's the latest this morning. The S&P logging its third session of declines at Thursday's close, with AI disruption fears roiling equities, causing investors to pull back from mega-cap tech and software. Bloomberg's Mandeep Singh joins us now for more. Mandeep, welcome to the programme, and welcome back, I should say. Mandeep, the level of anxiety around the tech story feels different. Does it feel new and different to you?
Well, right now what we are witnessing is, obviously, there is anxiety around this build-out of CapEx, but also what we are seeing with the component prices, especially memory. And now I think people are debating, yes, the hyperscalers raised their CapEx, but then how much of that went to memory prices? And I think that trickle down to the overall market is everyone sees the Anthropic release. In fact, the numbers we saw yesterday, they went from $10 billion ARR to $14 billion ARR in 6 weeks. That kind of growth is phenomenal. So enterprises are allocating their dollars, and whatever model they have released is really working from that standpoint. The question that needs to be asked is, what does it mean for the margins? Because a lot of these companies right now are giving away their product under cost. And with the inflation we're talking about, the memory prices, I mean, you have to ask yourself, yes, things can change, but at what cost and at what margins? And that's where I think the impact is still not clear. There's a lot of noise, and everyone is trying to figure out, what really gets impacted, because the costs are really going up when it comes to building this AI infrastructure.
Well, Mandeep, let's stay on that and let's talk about the victims of it. How does Apple fit in with a big move lower yesterday?
Well, I think for a company like Apple, they have stayed away from investing in, LLMs altogether. Now that they are partnering with the like of Gemini, basically what they're saying is we will get the best model. Let the 3 or 4 companies compete. We still have a hold on the hardware until there is a new form factor when it comes to using these LLMs. I think Apple is still in a great position, and I do see, this arms race around raising CapEx, but it's going to impact margins big time, and it's just a matter of time. And so from that standpoint, Apple is somewhat insulated.
Apple hammered in yesterday's session. Mandeep, thank you. Down 5%, Bramo. Worst day for Apple since Liberation Day week.
Yeah, and it seems like maybe people were just selling it because they hadn't been selling it quite as much before. I mean, the fact that Amazon has been down 16% in the past 8 trading sessions gives you a sense of just the scope of the carnage. And it goes to the question that you have. And Apple's sort of a different story because they're more of a consumer of this. But it goes to the story, if they're going to be the big winners, why aren't they winning, right? I mean, if they're the ones that are disrupting everything and then are going to ultimately have to consolidate market share, well, why aren't people buying them at least?
Pete, which one is it? Can we make our mind up? We started the program like this. Either it's going to cause mass disruption and destroy lots of things because it's so good, or we're wasting money. Can it be both?
One thing I think that's coming up certainly in our discussions, electricity, right? 6 states now, I think, have actually put some sort of restrictions on the data center build-outs, right? This lack of electricity, will we actually be able to achieve all these things, right? Mandeep just talked about the chips and the underlying cost of the chips going higher, right? How are we going to get the electricity on board to do all this? Where is this all going to come from? And yes, I see it sometimes replaced. I still think this is much more of a unwind of liquidity. People got very comfortable in treating some of these companies like cash, right? We went from a world where, money markets are good, but like Apple's like cash. So I think people got very, very comfortable with risk. People were very excited, again, coming into this year, what was going on with this administration, where we were headed. And I think there's a bit of a pullback. Like, there's a degree of uncertainty, and you start seeing things come down. People say, like, you know what, I will sell. I will see if I can. It doesn't have the same feel. You're not getting that buy the dip mentality, right? I keep looking at these ETFs that, to me, kind of exemplify buy the dip. They're not getting the big inflows. You're not seeing retail come in. And that, to me, that's part of the reason we're getting these on-selling things. And we have not lived in a world where we've seen these big sell-offs for a while, right? People were very comfortable with these trades. They kept working. So I think there's a lot of room to unwind. I think that's just really all about positioning, and we are going to figure this out.
Would you be a buyer of this? I mean, is this a falling knife? Or does this look like something that is actually a really good opportunity?
I think we're getting close to opportunities in some. I'm looking at some of the wealth managers, for example. We're having some conversations around that. Yes, robo-brokers are going to do a certain amount of things. There is going to be a lot of hand-holding people want to do, right? People are still going to want to talk to people. I think some of these things are overdone. To me, again, it's about valuations. And valuations positioning until you kind of get this thing. And it's kind of weird, too. This has been the U.S. selling. It's not like we get overnight these huge futures moves. Generally, we've been higher in the morning, right? We went much higher after payrolls. We went higher yesterday morning. You're sitting there. I went into a meeting. NASDAQ futures were up 100-something. Came out of a meeting. We're down 400 points. So this is U.S. selling, right? I think it's an unwinding of positioning in the U.S., and people are less comfortable that we have to go higher.
Got 30 seconds left. What's Walmart doing with a 50 multiple?
Again, I think it's positioning the other way. Maybe that was what people were using short. Again,
Isn't that wild?
I think what we have to understand is people have all these trades, long shorts, and the systematic trades. Maybe Walmart was everyone's short, so that's coming back. It is pretty wild. But again, these are the companies that we're going to do well, I guess.
What a chair of Academy Securities, Pete, thank you. Appreciate it, buddy. Walmart reporting earnings next week.
Apologies, but honestly, after the pandemic, what did people do? They went out and they bought toilet paper. I mean, ultimately, you go out, you stock up in goods.
So you're in the February 2020 camp.
I mean, ultimately,
is
this not the same type of trade? I mean, it's the haven trade of stockpiling of the things that you need.
A 50 PE.
Clorox
Walmart.
wipes.
My goodness. Is that what you think this is?
No,
Eve
actually,
of the pandemic?
their business model, I think, has fundamentally changed. I think that's a big piece of it.
OK. Coming up on the programme, Tom Forte of Maxim Group. As Apple shares fall by the most since April of last year. Plus, Vonnie, how's your morning movers? Applied Materials soaring on a rosy forecast and memory demand. That stock is up by more than 11% in the pre-market. Stocks are down by a third of 1% on the S&P 500 following a three-day slide. 3 days, no gains on the S&P 500, wiping out the gains for the year so far on the benchmark. The S&P 500 heading towards the worst week of losses so far this year. On the Nasdaq, we're down by another 0.4%. On the Russell, the small cap softer by about a quarter of 1%. In the bond market, check it out. Bond yields on 10s, very close to the lows of the year, up a single basis point this morning, 4.1134. Think about it, near the lows of the year. Even though we had an upside surprise on payrolls, a downside surprise on unemployment, and a week ago, a really strong ISM manufacturing, and yet here we are at 4.1134.
Yeah, even the 30-year auction that happened yesterday, the dealers that normally have to buy if they are on an auction took down the lowest proportion of this bond sale on record. In other words, there was so much demand for 30-year treasuries at a time where suddenly people are talking about the existential risk of a deficit. Poof, all of a sudden that went away. Why? Is it because of the fear of some sort of downturn, recession? Is it because of Japan? I mean, ultimately, this is a real question at a time where there do seem to be some pretty massive market shifts.
That's the silver lining of the week so far. The bonds still work. Yields lower at the long end, 30s down to 4.74, up a single basis point on the session. As we count you down to the opening of this session, 3 hours away from the opening bell, let's get you some morning movers with Vonnie Quinn. Hey, Vonnie.
Hey, John. Yeah, some violent moves this early on in the session as well. Look at Applied Materials, up 11%, and you would think that a lot of the good news would have already been priced in here, right? Applied Materials in the perfect position right now. It makes the equipment that makes memory chips, and we know that memory chip stocks have been on a tear. Well, seemingly the demand is just unending. It beat on the top and bottom line and gave a fantastic forecast. So Applied Materials is off to the races this morning. Let's take a look at another stock that we're seeing a huge move in and maybe a little bit less expected. Rivian Automotive, the maker of EVs. Now, we all thought it was a hugely bleak outlook for electric vehicles, right? Not so, seemingly. So Rivian actually swung to a profit in the quarter, and it's betting the farm on a mid-sized SUV that's going to be all electric for this year, and it upgraded its guidance for its full year forecast. So seemingly EVs are popular still in some corners of America and the world, and that stock up 20%. Also got up many upgrades, but one in particular from Deutsche Bank upgrading its price target to $23 a share. Not so for DraftKings. Now, this is an online gaming company, obviously, and what have we all been talking about recently? Prediction companies, right? So the prediction markets are gung-ho. Online gaming, not so much. Also, there's really no moat here. You can have as many companies in this space as you want. DraftKings definitely didn't at all come anywhere close to meeting revenue or profit expectations, and it also gave a fairly bleak forecast, and that stock is definitely down 15% and suffering today, John.
Hey, Vonnie, thanks for the update. More from Vonnie in about 15 minutes' time. And our radar this morning, Wall Street seeing more than $500 billion in market value wiped out on Thursday across just 10 mega-cap stocks. Fears over AI disruption taking a major toll on the tech sector. Elsewhere, the DOJ's top antitrust official resigning following pressure from the White House. The move raising questions about how the administration may shift its stance on challenging anti-competitive conduct. And finally, the Trump administration working to narrow the scope of its tariffs on metals. Trade officials addressing the difficulties companies are facing since the White House imposed a 50% levy on foreign steel and aluminum.
This is exactly what Tchir was just talking about, that these are some of the crucial elements that go into a lot of the manufacturing boom that they're hoping to reignite. This goes to a larger point, though, that a number of different guests have talked about, which is that if they don't have that many levers to pull in a year where affordability is increasingly in focus, how much will there be a push to reduce some of the tariffs already in place? We're already seeing that in the margins from House Republicans. Do we see that taking shape in terms of lowering rates overall?
They're feeling the heat, and unemployment's close to 4%, and the stock market's 2% away from all-time highs, and GDP could be close to 3% by the end of the year, and they're feeling the heat. Now, bear that in mind when we talk about these AI stories. And we quote these AI officials, people from Microsoft, talking about wiping out white-collar jobs in the next 18 months. If they're feeling the heat now, what do you think the Washington response is going to be if we actually see technology that starts wiping out white-collar jobs across this country?
This is the reason why I thought that the Anthropic press release yesterday was so interesting. Anthropic's trying to get ahead of it and saying, yes, we need you to regulate us more. And by the way, we want to come into Washington and help you do that because we're going to help you craft that so that we can get ahead of it. This is the question. What is that response, right? What is the policy lever that Washington, D.C. is going to do? Is it going to simply say you can't have electricity? Is it going to simply say you don't have permitting to build out? Or is it going to say, hey, Kevin Warsh, lower rates, rates, drop them to zero and try to ignite some sort of growth. I mean, they're kind of in a bind here, right? Because the United States has always been a bastion of creative destruction. That has been the power, the engine of this economy. So how do you deal with that creative destruction if it is potentially the nuclear bomb of creative destruction?
And moving this quickly, and it's the speed at which it's moving that is of concern. That post that everyone's talking about, the viral post that we mentioned yesterday, the start of it, that it's February 2020. Let's just think that through just a little bit more. I understand why people are concerned and anxious about that. The technological development is real, and it's happening much quicker than people thought it would, even 12 months ago. But everyone's worried about March. Did everybody forget April? And the following 12 months, governments around the world threw everything at this pandemic to make sure that unemployment didn't climb because they knew what it meant for their jobs. But just think that through. Never mind February 2020 and being obsessed about March. Think through April. Think about the government response to the pandemic to try and insulate the labour market from the economic shock. That's what you've got to bear in mind, how Washington will respond if some of these fearful forecasts actually start to materialise.
It's a great point. It's a really important point. It's the reason why people's eyes are turning to Washington as they see some of these developments take place. I'm just not clear on the policy prescription in response to this type of creative destruction when Washington, D.C. doesn't seem to understand it as quickly as it's moving. And that a lot of people don't have their heads around exactly how developed some of this technology is and what its potential is. And when there is this arms race globally, right? China is not going to regulate it into obsolescence. They're going to invite it more because they want to dominate. So what is the policy prescription if it's not throwing cash and dropping rates to zero? That seems to be where President Trump is trying to push it with Kevin Warsh. But is that really going to change the dynamic in any material way?
Well, China's an interesting example, because the labour market and unemployment in China is existential risk to the Communist Party. Literally, the whole thing gets shut down if people start to come out with pitchforks because they can't make a living. So how governments respond to this, the same thing will apply to China too. They can't just sit idly by and let all these companies make tons of money, hand over hand, fist over fist, and then just watch people lose their jobs. That's not going to work out for any of these governments.
I would agree with that. You're seeing right now in China the unemployment, the youth unemployment rate at 20-some-odd%, and they're having to crack down on a number of dissent that is percolating to the surface. That's already somewhat there. I will say going forward, again, though, how are they going to address this? Is it going to be training programs so that we can all become gardeners? Are we all going to learn how to refine metal? I mean, there are certain jobs. Are we going to become plumbers? Because evidently plumbing pays a lot if you've ever had to fix anything in your house. So there's a lot of potential jobs that do still have a place, but they haven't been the ones that have been most popular over the past couple of decades.
Let's keep it on tech. The Nasdaq 100, as you all know, on track for its third straight weekly loss. Thom Forte of Maxim Group covers Apple and Amazon with a buy rating on both. Thom joins us now for more. Thom, the anxiety is overwhelming this week in the tech sector. I don't even know if it's reached Main Street just yet, but on Wall Street, the fear is sky high in two names that you cover, Apple, Amazon. Let's start with Amazon. Lisa mentioned this 8-day run of declines, 18% lower on Amazon. What has made that stock fall out of bed over the last week?
Yeah, so when you think about the weakness in Amazon, I think it's entirely related to the $200 billion CapEx guidance by the company. And if you look historically, without downplaying the significance of a $200 billion CapEx number for Amazon, but Amazon has a track record of ramping investing when necessary to take advantage of opportunities. And I do think that net Amazon can take advantage or capitalize on AI in ways other mega caps can't. They have 1.5 million employees, many at the large fulfillment center level. To the extent that they roll out robotics, add automation, they can have greater efficiency. Now, you've been talking a lot about AI displacing jobs. So I think that if you do the math equation for Amazon, it would be to the extent that automation reduced the headcount at the warehouse level. But at the same time, you have to think about the new jobs that automation would create to the extent that someone has to make the robots, service the robots, things of that nature. So yes, I'm concerned about job loss from artificial intelligence, but I think it's going to be an offset of job loss, but also some job gains.
You know, Thom, John opened the show asking about this conflict that I think really is the conflict. Either this CapEx that all of these big tech companies are spending is not worth it and ultimately is going to backfire on them for becoming asset heavy and not as profit heavy. or people are just totally mispricing the story, and the disruption is actually, yes, significant on the other side, but is going to benefit these companies in a significant way. Which is it?
Well, okay, for Amazon, again, I'm of the belief that it'll be worthwhile. And I think what's interesting as a student of, having started covering the internet in the late 90s, I remember the build out of dark fiber and things of that nature. So I worry that we're going to have this, ghost data centers in the future and things of that nature. But the good news, I think, for Amazon and for other mega cap tech companies that are ramping their CapEx is that presumably if they don't see the returns, they can scale back the numbers. It isn't that Amazon spending $200 billion in one day. So if you look at Amazon again, they've scaled back some of their leasing commitments when they determined that they didn't need as much fulfillment center square footage because there wasn't the demand. So I do think that as it pertains to Amazon, if they're not seeing the positive performance that they're expecting, greater efficiency at the warehouse level, greater efficiency also at the software engineering level, better sales from e-commerce, things of that nature, it's not like they can't stop the spending. They can turn it off.
Thom, is the tech really that good? Is the AI really that good to disrupt all of these potential industries? Is this sort of heat-seeking missile that Joe Amato of Neuberger Berman was talking about, is it truly that in terms of its efficacy?
So you're asking me, so today, we'll call it, day before Valentine's Day, 2026, is the technology that good? To the extent that I have, spent a lot of time with Alexa and Siri as an example of, AI and things of that nature, the answer is absolutely not. The question is, in the future, will it be that good? And it remains to be seen. But I would say, Lisa, today I'm convinced the tech is not that good, but that doesn't mean directionally we're not heading to a point where it'll be much better than it is today. And I think that's, very much possible.
Thom, I'm not going to ask you if you're spending Valentine's with Alexa and Siri. I'm not going to ask that question.
You just did.
But you basically asked it yourself.
Taking my wife to dinner, but thanks, Jonathan, for worrying about me.
Otherwise, you could have joined us. I was concerned. So I'm going to follow up on Apple. I want to talk about Apple very quickly. 5% move. Is this the threat of a margin squeeze from memory, or is it about falling behind with AI? What's the move about?
Has to be the margin squeeze on memory. So, Jonathan, I was thinking back to last year being on your show and wondering if we had a super cycle for AI for Apple. 20% growth in iPhones in the December quarter would make us think yes, but they're nowhere with AI. So I think that the 5% move is concern on memory. Apple historically does very well when they have a product selling as well as the iPhone 17 and improving the margin over time. They could take price, managing supply chain is Tim Cook's forte. So I'm not worried about memory maybe as much as the market is right now.
Hey, Thom, I'm not worried about you. It's good to catch up. Thom Forte of Maxim Group. Thom, thank you. And a happy Valentine's Day to Mrs. Forte this weekend as well.
I wonder if anyone's actually doing that. Hey, ChatGPT, will you be my Valentine?
Bramo, kinda. It's happening.
I know, but maybe they just provide, really good feedback.
I saw a headline about a restaurant opening up where you could take your AI partner recently. Did you read that headline? No. When you see those headlines, you don't actually click the stories and read them because I just no.
You can't get that depressed.
No, I don't. No.
If it makes them happy, it's sort of like a niche.
I'm all for it.
It's like a furry, but
Try not to get involved in other people's business. Do what makes you happy.
What do you think?
Absolutely.
If they should come up with another name, not furry, but like body.
I'll let you take some time to think about it. Okay. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Trump says he can see negotiations with Iran stretching for as long as a month as he seeks a diplomatic agreement that would roll back Tehran's nuclear ambitions. The president also saying it will be, quote, very traumatic for Iran if it fails to reach an agreement. Trump's comments coming a day after he met with Israeli Prime Minister Benjamin Netanyahu at the White House. Global ports operator DP World is naming a new CEO and chairman. The announcement coming after emails released by the U.S. Justice Department showed Sultan Ahmed bin Sulayem swapped emails with convicted sex offender Jeffrey Epstein. Sulayem was one of Dubai's most powerful executives and was in touch with Epstein for more than a decade after Epstein was first jailed in 2008. L'Oreal shares trading lower in French trading. The beauty group posting disappointing sales growth in the fourth quarter. Results at its Luxe division, which includes Lancôme and Yves Saint Laurent, were hurt by a persistent slowdown in the travel retail business in Asia. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Up next on the programme, it's CPI Friday.
There is a potential disinflationary trend that's in place. I think shelter will be key to that. The Fed has missed their inflation target by a wide margin for now 5 years. I think it makes a lot of sense to them to be cautious about adjusting policy lower.
Andrew Hollenhorst of Citi joins us next, live from New York City. You're watching Bloomberg TV. Three days, no gains. It could become day four. Equities are softer by a third of 1% on the S&P. On the Nasdaq 100, we're lower as well by a third of 1% also. It's a reset for 2026, a reset because we're back to zero again. In fact, negative on the year now on the S&P 500, wiping out the gains for 2026 so far. Under surveillance this morning, our next stop, it's CPI Friday.
There is a potential disinflationary trend that's in place. I think shelter will be key to that. It's pretty clear from their dual mandate objectives. They're missing very clearly on one, but the labor market looks much closer on the other. The Fed has missed their inflation target by a wide margin for now 5 years, and the labor market is very close to what they think full employment is at this point in time. With that context, I think it makes a lot of sense to them to be cautious about adjusting policy lower.
So here's the latest this morning. Traders turning to the next inflation read at 8:30 Eastern Time following a blowout jobs report which pushed out Fed rate cut bets. Andrew Hollenhorst of Citi writing, in our base case, we have the Fed cutting interest rates 75 basis points this year across April, July and September. Andrew joins us now for more. Andrew, good morning.
Good morning.
Just remind everybody what your jobs guess was.
We were just within 5K of the actual number. But, I was talking to Lisa about this before. The question is, are you getting the number right? Are you getting what's going on in the underlying economy right? And we were close to the right number. It was a strong jobs report in that sense. But like you were talking about earlier, there's a lot to look at here and think that really the labor market's not that strong.
So you think the number this week overstates the strength of the economy?
Absolutely, and I think we've seen that consistently at this time of year over the last couple of years. This is residual seasonality. I think we talk about it every time I'm on now, which is just such an important feature of the data now. The reason we had that strong forecast for payrolls, or that high forecast for payrolls, I should say, is because of that residual seasonal pattern. Every January you get a strong number, and then we'll get numbers over the remainder of the year that aren't going to look as strong.
Andrew, this was no victory lap. Come on. You had almost the perfect numbers. You were supposed to come in here and say, yes, we nailed it. Our team absolutely crushed it. We had 135. It came in at 130.
They failed by 5K.
I mean, instead, exactly. We failed by 5K, and it's hard to understand exactly all of the details and what this actually means. Look, how much are you focusing on the breadth of the jobs gains as a real indicator of how fragile some of these numbers actually look?
Yeah, that's another way to look at it. I mean, again, you just start pulling this report apart, and there's more and more reasons to think that it's really not that strong. Almost all of the job gains that we're getting are in healthcare, education, and leisure and hospitality, with healthcare being the biggest of those three categories. So this is very, very focused job growth. What you want to see in a healthy economy is job growth across the economy. And then remember, we think that these numbers are being overstated by something like 60,000 per month. You look at a moving average and you adjust down by that 60,000 a month. We're close to zero net job growth, which maybe that is consistent with labor supply that's slowed down a whole lot, but it's still not a healthy thing for an economy.
We'll get into inflation, but it's Existential Friday and we're worried about our jobs. So I'm just wondering if you get a sense under the hood that there are certain sectors that are losing jobs as a result of AI, or uncertainty about exactly how this will play out for companies that are holding back on hiring.
Yeah, it's hard to see that in the data. You would look at certain sectors and say, are we really losing jobs in a big way in the sectors that we would expect to be affected more by AI? And instead what we see, which is interesting, I think, and maybe telling us something about what's going on, is just a general weakness in hiring, firms that are reluctant to hire. And I do think that has something to do with AI. It probably has something to do with the overall macroeconomy. But you have a lot of CEOs out there, a lot of CFOs out there, and I think they're thinking, what if we do get these productivity improvements from AI? Is this the right time to be hiring? If I'm losing some employees now, should I be replacing those roles? Or maybe I'm just going to wait and see in 18 months from now, will I be unhappy that I increased my payroll? So this reluctance to hire, I do think it has something to do with AI.
When do you expect to see more weakness in headline payrolls?
I think that we'll see that really as we get into the spring and summer. This seasonal pattern, you hire a bunch of people into the holiday season, then you lay those people off in January, then you start hiring again as you get into the spring and summer. And when that hiring is supposed to pick up, that's what we've seen over the last couple of years. You seasonally adjust those numbers downward and we get weaker readings.
Is that coming with hotter or softer inflation in the months ahead?
I think that it will be coming with softer inflation. That is critical.
You sound hesitant.
Well, I'm hesitant because we've seen inflation that, especially at the beginning of the year, again, I'm going back to residual seasonality again. January and February inflation prints have just been strong the past couple years. We think it's going to be a softer reading today, but there's a lot of uncertainty around what exactly the reading is going to be. I do think by the time we get to the end of this year, we'll have a pretty clear, slower inflation trend. I think we have actually established that in the underlying data and the details. But are we going to see that today? Are we going to see that in the next couple months? It may be a few months before we see that.
What kind of number would we have to see for the Fed to be justified in cutting rates as a result of disinflation, not because of labor weakness?
Yeah, I think if we're reasonably comfortable that core inflation is running down more at 2.5%, which on a year-on-year basis we're not that far off of, I think that's a pretty comfortable place to be reducing policy rates. And I think many others would not get into this game, which I think we were in before the pandemic, of looking at every 10th of a percentage point on inflation, because we're talking about how the numbers are imprecise and there are issues in terms of just measuring inflation. So if you're at 2.5%, you're basically at your target. That you're basically 2%. So if we're comfortable that that's where we're running in an underlying sense, I think that you can be reducing policy rates. What Chair Powell is saying now, and I would agree, is that the elevation in inflation is all due to goods inflation right now. So what you really need to see is that goods inflation slow. It should, because tariffs were almost a year ago now, came into effect 6 months ago. And we should be seeing that kind of upward pressure on goods inflation fading, but that's a key question.
Is the disinflation coming from a cyclical softening, or is it coming from AI? And this is important in terms of the read-through for risk assets.
I think it's coming from a cyclical softening, and I think that's really consistent with what we're seeing in the labor market. You are seeing job openings that have come down. You're seeing the employment cost index, right? So this is all the other employment statistics we look at outside of that monthly jobs report, which always gets all the attention. Employment cost index, this is our best measure of the costs of labor. And that has been slowing, and it slowed again in the numbers that came out earlier this week. I think that should be really reassuring for Fed officials, because that's the key input for services inflation, and you're just not seeing inflationary pressure there.
Does it feel like mid-February to you? It feels like the middle of the year.
Yeah, absolutely. Yeah, it feels like we've been doing this forever.
Do clients feel the same way right now? Are they just exhausted and overwhelmed by all of this?
Yeah, I think that's maybe part of why we're starting to see some volatility in markets, because people are starting to think about what does this really mean for the longer term.
True. Andrew, it's good to see you. Thank you, sir. Andrew Hollenhorst of Citi. In about 2 hours' time, we'll catch up with Jonathan Golub of Seaport Global. He's got a counterpoint to all the gloom. So looking forward to that. He said it's become quite in vogue to talk about how punk the economy is, weak growth, deficit spending, all of that. But from the market's perspective, from his perspective, incoming data looks good. Dare we say, pretty darn good. He likes financials and discretionary heading into the midterms.
And you hear this from other equity analysts as well. I just think about Steve Raschuta yesterday, an economist, not necessarily an equity investor per se. However, he came out and he was like, stop parsing the data. The data look good. Look at it. It looks good. Buy. I mean, essentially, it's that simple. So there are more people on his train.
He'll be happier over the long weekend, I'm sure. Coming up on the programme, we'll catch up with Sarah Hunt of Alpine, Saxon & Woods, Bloomberg's Mandeep Singh and Kelsey Berro of JPMorgan Asset Management. The second hour of Bloomberg Surveillance up next.
Inflation's not sticky, it's stuck.
The Federal Reserve has to wake up and smell the roses that inflation is stuck at these levels.
And that's why we say get used to 3-ish inflation. That's here to stay.
Because you look ahead, there is a potential disinflationary trend that's in place.
Rate cuts, if and when they come, will be based on inflation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. 3 days, no gains. The losses continue. We're down by 0.2% on the S&P. On the Nasdaq, we're down by 0.17. A little bit of weakness as well in the small caps. In the bond market, very, very close to the lows of the year on a 10-year bond yield this morning, up a single basis point to 4.1077. Going into this, 90 minutes away. The last big data point before the weekend. We can't wait. You all need it. Inflation just around the corner.
You all need it. We all need it. I mean, this has been a week of all weeks. We're looking for an inflation read at a time where there's a growing chorus of people who are saying to the Federal Reserve, look, you don't have to rely on the labor market falling out of bed. All you have to see is disinflation, and then you can cut rates. So do your thing. And so ultimately, JPMorgan sees a 0.4% or higher, leading to a sell-off because that sort of undermines that argument. But if you see less than 0.3%, you could see a significant rally because suddenly it's back on the Fed and the put returns.
And then we can all relax. Is it as simple as that? I hope it is. How many different narratives have we had so far? It is the middle of February. I keep checking the date. Sell America, debasement trade, one big rotation, the rest of the world, international, Japan, South Korea. And now all of a sudden it's sell everything. Because AI's coming for you.
Kristen Bitterly yesterday was on of Citi Wealth. It feels like 3 months ago that she was on, so I'm wondering whether it was actually yesterday. And she said that in her survey, 60% were relatively bullish, 20% were somewhat more pessimistic about AI, and 20% were confused. I think that section, that 20%, grew to about 80%. I was just going to say that because ultimately it's just mind spinning to try to figure out which squirrel to chase at a point when it's moving and moving violently. I'm just looking right now. 30% of the S&P 500 members are at 8-week highs. 15% are at 8-week lows. This is dispersion upon dispersion, but without themes that you can really follow in any kind of way.
Devin Ryan of Citizens yesterday on this program called it the AI vigilantes. It kind of feels that way. And when you identify some of these stories, like the company that was a karaoke company, but is now a logistics firm.
Love this story.
And is sinking the whole sector. Where are these stories coming from? Who's finding them? How are they being marketed? All these headlines we've been reading all this week. Who's in control of the narrative right now? Because it feels like things are a little bit too wild.
Will that short seller please stand up? Because right now it feels like people are looking for a story to kind of lob into the fire and see what explodes. I love what Deutsche Bank, Jim Reed, had to say. I've seen some shocking karaoke performances in my time, but this perhaps tops them all, given the fact that you have this tiny company with no proven track record that is sinking billions of dollars of market valuation, taking it from the overall index. You're right. It's correct to be skeptical, but the scope of these moves in a market that typically is equally skeptical highlights just how much of a fear factor there is. The fact that there's so much selling that follows one little grenade that's lobbed into a massive field highlights just how jittery and volatile people are feeling.
The progress is real. The development is real. The speed is real. All of that is real. And the issue that a lot of people in these stocks on the long side have right now is something we've discussed over the past week. From software to wealth management firms to logistic firms, take your pick, real estate. It's difficult to prove the negative. It's hard right now to sit here and say these things won't happen. So people are just selling now, and they're going to sit back and ask questions later. And that's the problem. That's going to be the overhang now for the months to come. It's got to be a show-me market. These guys will have to put up fantastic earnings consistently and show that they are ahead with regards to the technology.
Yeah, and the difficulty right now is that narrative, which is very logical, is getting muddied by a lot of forced selling and by CTAs that are getting stopped out of positions. And I look at gold. Why was gold selling off so significantly? Somebody needed to raise a lot of cash in mass, and they've been selling gold in order to finance some of their short positions that they need to cover. So there's a financialization and a lack of liquidity overlay that exacerbates some of these moves and makes them feel more painful when it might be a margin squeeze. It might not be necessarily an existential threat to the entire business model.
And that's a new dynamic.
Yeah.
That's a new dynamic. So picking out the one karaoke firm and saying that it did all of this, it's a little bit too cute. It's a little bit too cute.
But it's a great story.
Fantastic story.
Actually,
I'm enjoying the story too.
You can't make this stuff up. I mean, honestly, how does this come out of Hollywood? This is just too rich.
It's kind of ridiculous, because maybe it is. Ridiculous. Equity futures on the S&P 500 negative by 0.2% this morning. Coming up this hour, Sarah Hunt of Alpine Saxon words as Wall Street tries to stop the bleeding. Bloomberg's Annmarie is going to join us as Venezuela ramps up oil production. Looking forward to catching up with AMH in just a moment. Plus Kelsey Berro of JPMorgan Asset Management as investors eye a fresh read on inflation. We begin this hour with stocks trying to find a firmer footing following a broad tech sell-off. Sarah Hunt of Alpine Saxon words writing investors are looking to move out of higher valuation stocks as the AI juggernaut comes for a new vertical every single day. Sarah joins us now for more. So, Sarah, they're seeking out another high valuation stock. It's Walmart. at a 50 PE?
Well, so it's interesting because I was listening to you guys talk about Walmart earlier, and I think, I mean, if you go back and look at Costco and you look at those giant moats where people are like, no matter what happens, they're going to go there. There's a reason that people feel more comfortable in that space right now, even if it is a high valuation space, because it seems a little bit harder to disintermediate buying stuff with AI. And it also seems like people are looking for the places that are least vulnerable. Whether or not that's the case, we don't know yet, but it's certainly been driving a lot of the movement.
We did this 12 months ago with DeepSeek. Is this different or another head fake?
It's really hard to say, and I think the biggest problem is that we all talk about it, and as we're all trying to learn exactly how things work, it's hard to your point, disprove a negative. If I say that this is going to come for you no matter what, it's difficult to say, no, it isn't, and this is why. And I think that this is the biggest problem, is really trying to understand exactly what the technology is displacing, because are people going to be comfortable listening to only AI and not talking to any people, which is the direction that right now that, that the market is going.
So what are you more comfortable in? Highly priced consumer staples right now, or software names that have been absolutely hammered over the last week? If you had additional capital to deploy at the moment, where would you put it?
I'm looking more, or we're looking more collectively for the combination of, you've got some real world assets on the ground and you're a company that makes things, you've got good cash flow. It's difficult to think about a pipeline, for example, or an energy company being disintermediated by AI. I think one of the biggest challenges is going to be that electricity that we've all been talking about. There was a story this morning that Germany was basically put the kibosh on a data center going in someplace because they didn't have the power resources. We talk about that in this country because electricity prices have gone up. We're looking now at what the software can do, and then saying maybe, on the other hand, can we build it as fast as we were going to build it? Do we need to build it as fast as we were going to build it? Because that's another question. Is the speed and the technology going to catch up with the chips? I don't think we know the answers, and it's that unknowing that makes people much quicker to pull the trigger to say, let's step back and see what happens.
John made the point earlier that in this viral post, it was February 2020, and John was talking about how everyone's looking past the fact that in April 2020, the bazooka came out. I'm just wondering how much you're starting to anticipate what kind of policy response there is going to be, whether it's restricting some of the electricity demands by some of the AI companies, whether it's throwing money at the cause to try to train people to get them into jobs.
I think that is also something, you don't know what the response is until you know what's actually happening. Right now, we have an enormous amount of anticipation of what may happen. You can see certainly that things like on the travel side, websites are having a hard time. Hotels valuations are going up. Why? Because they own the hotels. And you can't take that out of the picture. If I'm going to go stay in a hotel, I have to actually be in a physical plant. So there is a bifurcation of what people are looking at. Is this a digital asset? Is it a real asset? Who controls what and how? I mean, even some of the stocks that got sold off yesterday, some of the automation stocks, there's a software component to that, but it's also into the entire automation product. You can't take those two things apart just because I can write an app to do anything. So I think that there is very much of a knee-jerk reaction to, we just don't understand how this is, and things are expensive. And I think that that's really been fueling a lot of the last 3 days.
Is the U.S. market just too confusing? Are people just like, all right, I'm going to go to China where it's a lot clearer and that maybe valuations are a lot lower. I'm going to go to Europe because it's maybe a lot clearer and they've been so beaten up that can't lose too much.
Well, if you think about it just from a purely thematic standpoint, one of the big reasons that the U.S. market had outperformed Europe for so long was the technology piece. If the technology piece is what people are concerned about, you go to markets where that's less of an issue. It's not an issue at all in Europe, but the valuations were lower, and you don't have quite as much movement on the idea that I can get rid of entire sectors with AI the way we've been talking about it in the U.S. So I think that there's a difference there, and it's hard to say that you shouldn't go looking in other places when you've got valuations that are cheaper and you have less of a market that is being perceived as at risk, as you see right now.
So the regulatory burden in Europe becomes a benefit? Is that how we're framing this?
That's what it ends up being, like what I just talked about. I'm thinking exactly where's that going? And it's because you can't do as many things and or people are saying, no, you can't do this right now. I just think that the U.S. market has been a technology-heavy market and has been a huge benefit. And right now, the big technology companies that are spending a lot of money are under pressure because they're spending so much money and people are looking at that. And the ones that are in the ancillary atmosphere, people are worried that they won't have a place.
Can you identify any financial risk accumulating at the moment?
Well, I think that the moves being so big is telling you that there was, you look at the margin levels of margin debt and you look at the leverage in the system, and you have to think that as the market has wound up like this, using leverage, it also can wind down a little bit when that leverage has to come off. And to your point about margin calls and everything else, there has to be some carnage under the surface because there's so much movement in both individual names and in sectors.
Do you think that treasuries are the haven now of choice? Not necessarily gold, but treasuries, because they hadn't served that way maybe over the past 6 months and increasingly could be susceptible to some sort of policy response?
Well, I think you're seeing that in the short end of the curve, but I'm not sure you're seeing that so much in the long end of the curve. And what the U.S. wants, arguably, is lower rates on the long end so that you get better mortgage rates and some relief there. It's the short end that's been coming down on the back of some of this. And even the move higher after the labor picture did not really last very long. So I think people are using it, but I would say more short-term than long-term.
So you wouldn't be buying. So you wouldn't be buying the long end of the Treasury curve right now as a haven asset, the way that at least the narrative seems to be painting it. It's working.
Well, and it very well could. I mean, that's the other thing, is that if you get a slowdown, it could work for reasons you don't want it to work, right? Because longer-term rates might come down under those circumstances, and therefore then you would want to be in the longer end of the curve. I just think that there's so much uncertainty. It's difficult to say that's a place where you feel comfortable right now.
Sarah, it's good to see you. You're going to stick with us. Sarah Hunt of Alpine Saxon Woods with 30-year bond yields this morning, just about unchanged at 4.73. Let's get you an update on stories and news worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The federal government heading for its second partial shutdown in as many months. The Senate going into a week-long recess without reaching a deal for new limits on immigration enforcement. Under a shutdown, most DHS employees will be expected to work without pay. Goldman Sachs' top lawyer, Kathy Rimler, is leaving the firm following the release of documents showing her connection to convicted sex offender Jeffrey Epstein. Rimler was hired by Goldman in 2020 and disclosed to the firm's leadership that she had previously dealt with Epstein. In a statement, CEO David Solomon said he respects Rimler's decision to retire. NASA launching 4 astronauts to the International Space Station, replacing a crew that was evacuated early due to that medical issue. The crew's mission is aboard a SpaceX Falcon 9 rocket. The astronauts should arrive at the ISS by tomorrow afternoon. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate the update. More from Vonnie a little bit later. Up next on the programme, AI anxiety.
It's no longer, we're just going to take at face value the AI trade and everything's going to grind higher. People are starting to ask the question, what is going to be disrupted? And then also, when are they going to start to see the productivity gains?
Up next on the programme, we'll catch up with Bloomberg's Mandeep Singh, plus more from Sarah Hunt from New York City this morning. Good morning. Stocks are down once again. Could be a 4th consecutive day of losses stateside. Equity futures down by a third of 1%. On the Nasdaq, down by a third of 1% also. As for the sectors, staples heading towards a 6th week of gains. IGV, the software ETF, getting kicked around. That's heading towards a 5th week of losses. And that's really the story of the moment. In the bond market, 10-year yields near the lows of the year, 410. 410, even with a blowout jobs report earlier on this week. And a lot of doubt around that so-called blowout jobs report earlier this week.
Yeah, even with all the debt sales this week coming from both big tech and the U.S. government, still yields are down significantly, which raises this issue. Is it because the people are expecting that Kevin Warsh, one way or another, is going to get those yields down? Is it because of Japan and the fact that people seem to be less worried about some sort of fiscal overhang? Or is it that bonds are acting as a haven again? And that, I think, is what a lot of people are leaning into for hope, given the fact that gold is suddenly acting like Bitcoin.
So that's treasuries, and yes, precious metals too. The interesting thing for me is corporate debt. We started the week with that massive alphabet issue, and it was sucked up, eaten up. The drawdown was fantastic demand that we saw come not just from corporate America, or rather investment America, but also from the Europeans as well. So the credit market has decided I'm getting paid by some of these companies. And the stock market's worried about existential risk. And there is a bit of a difference there at the moment.
This goes to the psychology right now of markets. You can't price uncertainty. And this level of uncertainty is getting increasingly difficult for people to price, and you can see that. The idea that you can get a coupon payment is a level of concrete understandability that I think a lot of people like, which is the reason why there's a focus on income. At least you know what you're getting. And that's the reason why you're not even seeing spreads widen that much, even as you see specific sectors completely fall out of it.
In the stock market, we don't know what's going to happen in 5 minutes. In the bond market, there's confidence 100 years out. apparently.
Coupon payments.
What a week it's been. Under surveillance this morning, AI, anxiety.
It's no longer, we're just going to take at face value the AI trade and everything's going to grind higher. If you don't see the ROI, investors are getting less patient, and I think that's healthy. People are starting to ask the question, what is going to be disrupted? And then also, when are they going to start to see the productivity gains? It's not a bubble. It's really kind of the infancy stages of this, and that's going to then benefit a number of other industries.
So here's the latest this morning. Trucking and logistics companies becoming the latest targets of AI disruption fears. The industry joining the ranks of software, wealth management and real estate. Bloomberg's Mandeep Singh joins us now for more. Mandeep, welcome back. You heard Kristen Bidley there of Citi, and she used the word benefits. And I hope we can talk about that for a little bit, because we're all talking about existential risk and the punishment and the losses we'll see elsewhere. Are we going to see some benefits, and where?
Well, I think we have already started to see quite a bit of disruption when it comes to what Anthropic has shown with coding agents. And look at the cadence of their product releases this year. There is a reason why they went from, 10 to 14 billion in a matter of 6 weeks, because they have themselves released, a few new products, and the coding agent release that they had has empowered this narrative that, you can create a lot of customized software. So I know the narratives is what's driving the market right now, but underneath that, there is substance in the sense like this is quite a powerful model release from Anthropic, and same thing with what OpenAI is trying to do with Codex. So suddenly that coding agent is not just a category of its own, but also what it can do in terms of disrupting other categories. And that's why you're seeing this sort of reaction with stocks.
Mandeep, I think the private market firms are equally as frustrated with the moment. In fact, perhaps more so. This came from Mr. Arrighetti in the last week or so. If you're going to underwrite a narrative of AI disruption, you also then have to say, well, what does that mean for the productivity and the margin improvement in the rest of your book? Mandeep, what is it going to take for that to become the more dominant narrative in financial markets?
I mean, I do think, when it comes to workflows, which is what we have been talking about, how AI can disrupt workflows, you will start to see it impact certain types of jobs. But again, the way market is acting is, everything will happen at the same time. And that's where, the cost benefit analysis, the margin impact needs to be taken into account. And some of the software companies will be implementing AI on behalf of the clients. Right now, they were sort of naysayers in terms of, or they were probably too slow in terms of adding that AI functionality. This will force them to, really figure out what are the valid use cases that they need to incorporate as part of their software. And I think you will see more of that in terms of the software companies really doubling down on the use cases that they feel their clients should implement.
Mandeep, just before you go, I want to finish with this question. You followed tech in the industry for a long, long time. I often lean on you for your insights because they're far better than mine. When you look at what's happening with a company like Anthropic at the moment, how much of that is just the pre-IPO roadshow and how much of it is real? What's hype and what's not? That's what I'm trying to get my head around at the moment. Is this a big marketing push that's causing a lot of anxiety, or is it something more?
There is something more, and that's where the latest model release they had clearly has shown a leap in terms of the performance versus other foundational models. And anyone who was saying models will get commoditized, I think is wrong. So you are seeing these companies actually differentiate based on the functionality. And that's why you have seen so much momentum with Anthropic right now.
Mandeep, thank you. Mandeep Singh there of Bloomberg. Wait until the roadshow actually begins. Imagine what the headlines are going to be like then.
We're all going away.
My
We're
goodness.
not. Can I just say,
By Anthropic.
Can I just take a second?
That wasn't a trade recommendation.
I know, no.
It's just like
I like the small print.
It's always the same, isn't it? It's like you see the headline, the warning.
Yeah, exactly.
And at the end, it's always buy whatever we're selling.
Of course, which is the reason why buy Claude. Can we just take a note? Algorithm Holdings, the karaoke company turned trucking logistics company. Algorithm, its ticker is RIME, R-I-M-E. Brilliant. I just have to give a nod to that. Really, again, written for Hollywood itself.
Sarah, you've been tracking the same stories. Mm-hmm. How much of it is hype? How much of it is real? I think we all understand the technological developments happening much faster than we thought. And a lot of it is real. But some of it just feels just a little bit too hyperbolic. When I see headlines like we're going to wipe out white-collar work in 18 months, what do you think it is?
I think it's a combination. I think in some places there's going to be room to not do stuff. I mean, already you go into a fast food restaurant and you are encouraged to order on a thing and not with a person anymore. There are a lot of things that are going to change. What is going to be the ultimate answer for all this? I don't think it's going to be as hyperbolic as it sounds, but this is a more difficult technology to understand. The internet, when it first started, people were like, well, this isn't going to take off. It completely changed things, but not in the way that people thought that they would be changed, right? So in the scheme of things, where are we going to go next from here is hard to say, which is why it's so easy to say it's definitely going to decimate this industry, that you have to look at this industry, and we just don't know yet.
Jonathan Krinsky of BTIG had a really interesting note where he was talking about how the bifurcation is getting pretty extreme. He said the AI winners and losers, the moves in single stocks are getting more and more extreme. At a certain point, we begin getting concerned that the weakness supersedes the strength and the broad market becomes vulnerable. Are we getting closer to that point where the dispersion turns into actual general weakness?
It certainly has been across the leading sectors. And then the question becomes, what is going to pick up as a leading sector? Is it going to be staples? Because markets aren't going to love staples as a leading sector. What is going to take over from the hype that we had of AI CapEx is the best thing that ever happened to the universe to, oh my God, people are spending way too much money. And once that money is spent, it's going to be terrible for everything. That's where we are right now. We could flip that script in a couple of months. It's hard to see what flips that script right now because some of these things that are coming out are so good that people are looking at it who do the jobs and say, wow, this is something that could really be impactful for the industry. So that's why you're getting much more of a reaction right now than you did with DeepSeek, which was a quicker one.
Why wouldn't you just go back into the big tech names if you had faith that this technology truly was disruptive?
I think that I actually think for some of them, I mean, we were talking about Amazon earlier. I think for some of them, you absolutely would. People don't like to be in the middle of a CapEx cycle, but it doesn't mean that that's not a good opportunity to buy that stock. Because in the scheme of things, what this pushes to is more big and less little, which is tough for the whole small cap discussion because that was part of what was rallying early into the year. And the value discussion has a tendency to be more on the smaller mid-cap side than it is on the mega-cap side or the big-cap side. So I think that there's definitely room for that, but there will be more of an emphasis on people leaning into companies that seem less disruptible, and that tends to be smaller.
You mentioned the Krinsky note. His point is that semis have got to hold up.
Right.
And if they don't hold up, we've got a problem. Semis, the iShares Semiconductor ETF up for 9 consecutive weeks. Yesterday, though, some weakness. They should be the big beneficiary of all this CapEx. They should be the winners. If you start to see some real damage inflicted there, then sure, we got a big problem, given the weighting on the S&P from some of those big names.
Because ultimately then also means that the CapEx isn't going to be worth it or ultimately isn't going to come through in the same kind of way in an overall downtrend in the economy. And ultimately, that's why it does come down to the economy, to the jobs market, to the inflation backdrop, and of course, always back to Kevin Warsh.
There's a lot of cliches on Wall Street. One of my favourite is, if you think the world's going to win, what's the value of being short? And I do wonder if we start to get to that point in financial markets with this trade. If you really think disruption's going to be that great, that everyone's going to lose their job, and it's going to be the end of capitalism, what's the value of being short?
I'm looking for your tinfoil hat. I can't see it.
No, in fact, I'm saying the opposite.
But it's true. But it's true. But if the world's going
sure.
to...
What's the point of having money, like, they're going to take it all off you anyway. Might as well be long.
It's not, look, you're not wrong. I mean, you might as well just be long that. And long maybe your go bag.
This show is just full of existential risk today. It's just a little bit too much, isn't it?
I do think that it's getting a little bit overdone.
The divide's pretty amazing, though. Like, the concerns on Wall Street. Is this even reaching Main Street yet? Are they even thinking about what's being concerned and talked about?
They haven't been happy all year as Wall Street was screaming. So I think that there's been this divide.
Sarah Hunt of Alpine Saxon Woods. Sarah, thank you. This is Bloomberg. Equity softer, negative by 0.2% on the S&P 500. Softer also on the Nasdaq by about a quarter. On a Russell, we're down by 0.16%. 1 hour from now, CPI, inflation in America. The last thing this market needs is a hot print. In the bond market, 10-year bond yields near the lows of the year. The bonds are working, that's the good news. 410.38 on treasuries in the face of better than expected data from payrolls early this week and a decent ISM the week before.
Yeah, honestly, this otherwise should be a strong economy, and yet it does seem like people are going into bonds with the expectation that it's going to roll over. I think you're right. It does feel like something of a recession trade, or people feel like there is going to be something dramatic that's going to undermine some of the growth trajectory, or at least that is the expectation going into it. I'm just thinking about if we get a really hot inflation print, What happens? Do people get more optimistic? Do people just suddenly throw in the towel and say, forget it, I'm going on vacation for the next 2 months?
The problem with the data right now, that I can give it to you and no one really knows what to do with it?
I mean, honestly, where would it even come from that suddenly people start to get worried? Is it coming from Birkin handbags?
Kit Juice's SocGen put it perfectly last week about payrolls. We were meant to get it on Friday, and he turned around and said, even if we got it tomorrow, I wouldn't know what to do with it. It's kind of true of CPI, a little bit later as well.
Andrew Hollenhorst from Citigroup, he was supposed to do a victory lap. He got it almost bang on the nose in terms of the actual headline number. He comes in, you say to him, you guys did really well. And he said, we were 5,000 off, but who knows what this means anyway, which gives you a sense of just where people are.
Everyone's so downbeat already. What are we, 7, 8 weeks into the year? 7 weeks?
People are confused, and it's frustrating to feel confused, but there are some people who are making a lot of money, and I'd like to speak to them and exactly how.
Yeah, I'd like to talk to them too, particularly those on the short side in some of these sectors.
Finding things like algorithm.
Who found the karaoke company that's done so well?
Please stand up.
Yeah.
Call in.
A few hours away from the opening bell, let's get you some morning movers. Danny has more. Hey, Danny.
Hey, John, starting with an upbeat story for you, and that is Rivian beats across the board and booking its first annual gross profit, something that this company has never been able to do, and a really rare bright spot in an EV industry that's just been downtrodden with gloom. They also are going to start selling one of their more cheaper SUVs this year, so positive outlook for sales for them. So shares up a whopping 20.8%. Not all the stories are good out there. Pinterest, it was a miss on their guidance for their current quarter. Shares are down 20.8%. That really hurts. They also announced a lot of layoffs. They said that this was in months prior, that they're going to be shifting more towards AI. So that not helping them, at least for now. The company has warned in the past that things like tariffs have hurt some of their advertisers for categories like home goods. So that has clearly been weighing on them. Finally, Expedia. This is another one of those instances of a head-scratching market panic type moment, because Expedia had fantastic earnings. Their fourth quarter was the best in 3 years in terms of growth of their sales. The first quarter, also expectations easily beat Wall Street, but the commentary is around AI anxiety. Does Expedia get replaced by some sort of AI agent that can just book your travel for you? So who cares about the good earnings? Shares are down 5.8% in the pre-market, John.
Seen a few of those over the past few weeks. Danny, thank you. More from Danny in the next hour. Can we talk about a good story, Rivian? Just proof that if you make a nice-looking EV, a nicely performing car, people will buy it. And Rivian proving that's the case.
Just have door handles. Just have them that come out so that you can open the door. It's really nice. But yes, Rivian coming out and showing that if you make a nice vehicle, people will want to buy it. And they've got pre-orders up the wazoo. And I'm seeing an increasing number of Rivians. They're actually really attractive.
The new mid-size SUV is a very good-looking car, and I'm looking forward to seeing that on the road over the next 12 months or so.
In your doorway? In your driveway?
Who knows?
Oh, yeah.
I'll keep you posted. All right, let's see. All right. On our radar this morning, logistics stocks becoming the latest victims of the AI scare trade. A former karaoke company sparking the sell-off, announcing its logistics platform was scaling freight volumes without increasing headcount. Elsewhere, OpenAI delivering a warning to US lawmakers. The maker of ChatGPT claiming Chinese rival DeepSeek is distilling US models to gain an edge in the AI race. OpenAI also alleging DeepSeek is using increasingly complex methods to evade detection. And finally, Anthropic raising $30 billion in its latest funding round. The investments pushing the AI firm's valuation to $380 billion as it looks to compete with rival OpenAI.
So you've been talking about how a lot of the concerns and warnings are essentially a roadshow. Although I would say, how are they going to make money off of this? And this is really a key question. If Anthropic is coming up with these truly disruptive models, if they were trying to disseminate them and win market share, how do they get their margins up at a time where it actually is expensive to hire some of these people? So that will be something that people will be looking at. But they're raising money at a very quick clip. I mean, if you think about $10 billion a couple weeks ago, now it's $30 billion. The valuation's going up. I mean, it's just how big are some of these private market companies that are setting up to IPO later this year to potentially dominate indexes that currently don't even have their eyes on them?
There is a lot of paper that needs to be moved. There's a lot of debt that needs to be issued over the next 12 months. And certain headlines benefit those things. That's all I'll say about that. I don't think that the technology's a head fake. It's real. I just think there is a massive marketing component to a lot of this, and you're going to see more of it in the next 12 months.
I'd be inclined to agree with you, and I like that skeptical take because it indicates that maybe some of the fears of our jobs being totally eradicated in terms of necessity have been somewhat overblown. The people who are on the inside are talking about how quickly this is happening and how well this is sort of rolling out. I'll give you an example. Walmart. Sure. People are talking about how much their market cap has been increased. Is this just sort of people going into toilet paper unnecessarily? Is this a February 2020 kind of story that will fade over time? Walmart is investing so much money in artificial intelligence. They are using it in every part of their supply chain. They're using it for their warehouses. They're using it to get margin improvement that their competitors can't. So they can compete on price and they can get profitability and they have the data to show it. So people are looking at them in a different way. Who are the other beneficiaries of it who are going to experience a similar type of trend? It is going to be the bigger companies, but it is going to be a significant material benefit. It just maybe hasn't happened yet.
That's why that name is at a 50 PE ahead of earnings next week, which is remarkable. Elsewhere then, let's move on to energy. The US Energy Secretary Chris Wright travelling to Venezuela, meeting with the interim president, Delcy Rodriguez, in a push to increase foreign oil investment in the country. Anne-Marie's been speaking with the Energy Secretary in the oil fields.
In the first year, we'll see pretty significant 30-40% growth in Venezuelan oil production. We want it to be open to less corrupt, honest American, Western American allies for business. The influence of China and Russia and Iran that has been very large in Venezuela will become very small.
Anne-Marie joins us now from Washington. AMH, welcome back. Fantastic couple of days. We've all been tracking the story on your social media account on X. You heard Chris Wright there, the Energy Secretary. He talked about the influence of China, Russia and Iran. When you're in the country, do you see that influence? How obvious is it?
Oh, absolutely. And on the route to that facility we were at, that was a joint midstream facility between Chevron and PDVSA. You actually saw a Chinese facility as well as a Russian facility. And we should note that some of the flaring from those facilities are black smoke as opposed to what many in the oil industry would call cleaner flarings from the likes of Chevron. The presence there is profound when it comes to these countries. And that is why this is part of what this administration would call the Don Road Doctrine. Not only do a lot of individuals think on the left and the right of this country bipartisanly in Congress that Nicolas Maduro had to go, that something needed to change on the ground when it comes to Venezuela. But this administration also sees this as a chance to really push out the influence of the Chinese and the Russians in their, what they would call their sphere of influence. And he made that very clear to me yesterday, speaking in the oil field, saying that we want to make sure that U.S. companies are here and that this influence you see from, say, Beijing or Moscow, that starts to wane in Venezuela.
Does the interim president agree? Anne-Marie, I think that's the big question. When the Energy Secretary says the influence of China, Russia and Iran has been very large, it will become very small. Is the interim president on board?
Jonathan, I don't think she has a choice right now. Tomorrow marks 6 weeks from U.S. Special Delta Forces captured President Nicolas Maduro and brought him to Brooklyn in New York, and now she is this interim president. And within this month and a half, you see the highest-ranking U.S. official right there, Chris Wright, meeting her at the presidential palace. I cannot describe to you and emphasize how surreal and uncanny this moment is, how quickly this administration is moving to try to change the path and the course of this country. And she spoke about it. I asked her, do you plan on visiting the United States? She kind of shrugged and she said, a lot of work to do here, but at some point, yes. And an invitation was delivered to her. And then yesterday, before we departed, Chris Wright said you can expect other U.S. government officials, say another cabinet secretary, other U.S. companies to come to Venezuela and have these discussions. So the United States is going to be there. He used the term nudge to me. Others might use the term coerce or have leverage over this interim administration government until there's a free elections in Venezuela. So absolutely, she kind of has no choice but to go along here, especially given the fact that this is a government that relies 95% of their funding and their budget still comes from oil, even though it's a country that is only producing under 1 million barrels a day, not the heights we saw of 3.5 million barrels a day. So the opportunities are there for Venezuela. And the companies that can do this and turn it around are going to be U.S. companies, especially when you look at the likes of Chevron, which to our reporting is potentially going to get another exploration block from Caracas and potentially a new license from the U.S. administration.
Annmarie, I'm glad that you went there. It's one thing for Chevron, which already has a presence there. It's another thing for Exxon, where Darren Woods has already said, look, we're out of money in a significant way already. Why would we go back without certain security guarantees? Did you get any sense of what the security parameters were going to be, what the guarantees were going to be to entice the likes of Exxon back into the region?
So there's not going to be any security guarantees. And Chris Wright reiterated that yesterday to me. He also said this to us, of course, in Davos when he announced that he'd be going on this trip shortly. There won't be security guarantees, but I think part of this visit was to show that you can potentially go to Venezuela, operate, and be safe. If you look at the State Department's travel advisory, it says do not go there if you're an American citizen for arbitrary laws potentially that they'll come after you for, kidnapping, theft, and crime. On the ground, I was speaking to a lot of local journalists who said, look, actually, Venezuela has become a little bit more secure. It's not at the height it was when you had protests and tear gas and high crime. People do feel like the situation is getting more secure, and there is a lot of hope there. When it comes to some of these big oil players, though, what I thought was very interesting from my conversation yesterday with Secretary Wright was that he said these companies like ConocoPhillips are in active discussions with Delcy Rodriguez right now about recouping those billions of dollars they lost when Venezuela nationalized the oil industry decades ago. And he also said she understands that and has regrets that mistakes were made. So that said to me that she definitely wants to have a opening of a dialogue with some of these bigger oil companies to come back in. The scene yesterday was striking to me. 6 weeks ago, they captured Nicolas Maduro. And then yesterday, I was at a Venezuela oil field with Secretary Wright and Delcy Rodriguez. They toured the entire day today looking at these facilities. And I think that pictures what they want to project, that this is open for business and we want U.S. dollars back in this country.
It's incredible how quickly this story has moved. Annmarie, it's great to catch up. Welcome back. Looking forward to having you back in the seat next week. Annmarie Hordern, following her trip to Caracas, Venezuela.
Yeah, I was looking at the other areas that have level 4 do not travel warnings from the United States to see where she might go next. Afghanistan, Russia, Ukraine, Iran, North Korea, Syria, Haiti, Venezuela.
I think she's
Yemen,
done most of those,
and parts
with
of
the
Mexico.
exception of Haiti.
I know, so she can go through that list and figure out what's next.
Yeah, when she takes her next vacation. That'll be fun.
Yeah.
Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The Trump administration working to narrow its scope on some metal tariffs. Sources telling us here at Bloomberg, changes specifically target levies on steel and aluminum products that many companies find difficult to calculate and negatively impact consumers. Aluminum is trading lower in London after the report. The search continues for Nancy Guthrie, the 84-year-old mother of Today Show co-host Savannah Guthrie. The FBI doubling the reward for information leading to her captors to $100,000. They've also released more information about the masked man seen in surveillance video, saying he's about 5'9" with an average build, and he's wearing a black 25-litre Ozark Trail hiker pack backpack. Citigroup is boosting CEO Jane Fraser's 2025 pay to $42 million. The 22% increase follows a year which saw the stock surge more than any other Wall Street bank. The pay bump also puts Fraser's total package for the year just $1 million behind that of JPMorgan's Jamie Dimon. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, all eyes on inflation.
January and February inflation prints have just been strong the past couple years. We think it's going to be a softer reading today, but there's a lot of uncertainty around what exactly the reading is going to be.
Up next, we'll catch up with Kelsey Berro of JPMorgan Asset Management, live from New York City. You're watching Bloomberg Surveillance. %2 from all-time highs on the S&P 500, down just 0.2%. Everything's fine. On the Nasdaq 100, we're down by 0.25%. On the Russell, we're down by 0.2%. At the index level, just a completely different story. Beneath the index, it's messy. This comes from Chris Harvey over at CIBC. Staples, a favourite risk aversion sector in rarefied air with 16% outperformance year to date. In the last 25 years, the group has only seen greater annual outperformance 3 other times, and all 3 were associated with double-digit losses for SPX. The S&P 500 down just 2% from all-time highs.
This is the reason why the likes of Jonathan Krinsky are saying maybe we're getting to the point where you could see a broadening out, where you could start to see some sort of index level drawdown as a result of some of the rotating pain that we're seeing tied to AI. A real question of when the data will show that, because we didn't get that in the headline jobs picture, but people seem to be shrugging it off and saying, you're just not seeing the real thing.
We haven't seen a lot of index level stress yet, and that's the debate of the moment. Futures then just a little bit softer. In the bond market, yields near the lows of the year. On a 10-year at the moment, in the bond market, 4.10. Under surveillance this morning, all eyes on inflation.
January and February inflation prints have just been strong the past couple years. We think it's going to be a softer reading today, but there's a lot of uncertainty around what exactly the reading is going to be. I do think by the time we get to the end of this year, we'll have a pretty clear, slower inflation trend. I think we have actually established that in the underlying data and the details. But are we going to see that today? Are we going to see that in the next couple months?
Here's the latest this morning. Delayed January inflation data due out at 8:30 Eastern Time. The estimate in our survey expecting core CPI to rise 0.3% month over month. Kelsey, Berro of JPMorgan Asset Management writing, market participants should be prepared for a hotter CPI report in January after a few months of significant weakness. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
Before we get to that data, 40 minutes away, let's just talk about how different things are in Bondland. People are freaking out in equities for good reason in certain sectors. I understand the stress. In fixed income, how relaxed is everyone in fixed income?
Well, we're not relaxed. We're still focused. But what you are seeing is a situation in which fixed income demand remains extremely robust. And you're seeing it across the spectrum from not just treasuries, but also high quality fixed income. So whether it be the Google issuance that was done earlier this week, that was very well subscribed. Those bonds are still generally on sides relative to where they were issued, and that's despite the fact that we've had a fair bit of volatility this week. And then you look at the 30-year auction yesterday, which we were rallying into the numbers, rallying into the auction, and yet we still got record end-user demand. So the highest end-user demand in the history of the 30-year auction. So what we're seeing is continued demand pretty much across the spectrum. And the stress within the AI and the software names is still very, very concentrated. So you think about the high yield market, software makes up less than 5% of that index. You do look out into the leveraged loan space, and it's a little bit more than that. It's closer to 15%. But actually, where a lot of the software funding has come from has been the private credit space rather than the public space.
So right now in corporate credit, spreads are still pretty tight. 275 on high yield. Everything's OK. Supply comes in. Demand meets it. In IG, we saw that from tech. You mentioned Alphabet. Great. This is the frustrating thing for anyone who covers sovereign fixed income. If yields are up, it's problematic. And if demand is great, it's a problem too. Because why is demand so great for a 30-year bond issue? Where's that demand coming from, and what are people scared of? And I know that's really annoying for anyone in treasuries, because when yields were higher, it was sell America, debasement, people don't want to own the stuff. And when they want to buy it and really want to buy it, people are equally as concerned. So where's the demand coming from and why?
I think the demand is fairly well balanced between both domestic and foreign investors. I will say, though, this isn't happening in a vacuum. And one thing that I think is a little underappreciated is we've seen this bull flattening in the yield curve over the last week. And it's not just in the U.S. Take a look at how Japanese JGBs have moved. The 10s 30s curve in Japan is at its flattest levels in months. There has been very strong support for the back end of the Japanese curve. And I think, a lot of this is really tied together, because when we were looking at the underperformance of the long end of the U.S. curve at the tail end of last year and the beginning of this year, people were saying, is sell America back? And I was saying, I think this is kind of a broader fixed income technical story within broader developed market sovereigns. And now you're kind of seeing some of that retracement happen. So it's not just something that's happening here in the U.S., but it's also happening across other developed market sovereign debt curves.
When people talk about the Sell America trade, they mean a lot of different things. And Michael Hartnett of Bank of America put out a note this morning talking about the fact that stocks in Europe, Japan, and other international developed markets have drawn in $104 billion versus $25 billion to the United States. You've seen money move elsewhere. Are you seeing the opposite dynamic in fixed income in terms of international investors wanting to come to the United States because of relatively higher yields and, frankly, in some ways, better companies? I'm thinking of Alphabet and what they sold over in Europe, and they're actually seeing more value right now.
So there is the relatively higher yields. There's also the fact that there is quite a lot of liquidity within the U.S. fixed income markets relative to other markets that are smaller. I will note, though, that if you look at some of the issuance trends within the corporate market over the last week, Google didn't only issue in dollars. They also issued in sterling. And I think that is an indication that from the issuer side, they're looking at diversifying their funding book, which is a smart move on their part. And they're picking up the fact that there is incremental demand across other markets as well.
Do you think that what we're seeing right now with respect to spreads in U.S. corporate credit, and I'm talking about public markets, is not necessarily representative of credit risk in the way that it had been, because private credit has been the area that a lot of the stress has been concentrated? In other words, do you think that private credit is acting as a buffer right now, leading to that stability in public market spreads?
I think that's probably part of the story, but it's part of the story that's been kind of going on for a while now. So when I talk to our high yield analysts, on an index level, they say the U.S. high yield market is the best quality it has ever been, kind of full stop. And that is a function of some of that lower quality debt being financed within the private credit market. So yes, I mean, this is a fundamentally different market. And so the resilience, should be taken and understood within the context of better fundamentals for these companies.
Kelsey Berro of JPMorgan. Kelsey, appreciate it. Thank you. Are you getting at the old adage that maybe credit doesn't leave anymore in the same way that it used to?
I mean, that's essentially what a lot of people have been saying. And the reason why, when I look at the distress that we're seeing in equity markets and people say, well, we're not seeing it in credit, so it's fine, might not have the same ring as it has in the past, because it might not be comparing apples to apples in the way that it once was.
To your point, Kelsey just went through the numbers. If you look at high yield spreads are still super tight at 275, but their exposure to the story that we think is full of risk right now isn't that great. It's elsewhere.
It's leveraged loans and it's private credit. And a lot of people have mapped out just what proportion of loans or what proportion of private credit extension has come from some of the more highly disruptible fields. And it is a much bigger proportion. But it just goes to question, what are the signals right now? Where are we getting them? It used to be high yield spreads. Is that still the same signal if suddenly that's been muddied by what's going on over in private credit?
The stocks of private credit firms over the last 12 months, I guess, for some people.
Yeah, well, although that has also been idiosyncratic. And I think that we've heard something to say about it from Apollo and others. They are not that happy.
Very downbeat. Do you want an upbeat note? Jonathan Golub of Seaport joins us next. He's very constructive about the future. We'll catch up with Republican Senator Thom Tillis, Tiffany of Pimco, Caron of Morgan Stanley. The third hour of Bloomberg Surveillance just around the corner. CPI data 34 minutes away.
The things that have been driving the market over the last couple of years have now switched over.
It's no longer, we're just going to take at face value the AI trade.
We are very heartened by the embrasure of this rotation.
We think it's a stock picker's market, so you got to be selective. There's plenty of opportunity globally to diversify.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. Your scores look like this. Down again by 0.25% on the S&P, on the Nasdaq down by a third. In the bond market, new lows for the year in the last 24 hours. Very close to those levels right now on 10s at 410. Going into this, 29 minutes away, a CPI report in America.
So how high is the bar for this CPI report to be disinflationary enough to put the Fed back in play? Maybe that could give some calm to markets if you do do get some sort of disinflation. JPMorgan is talking about 0.4% bad, lower than 0.3% good. We'll have to look at the internals, but that is the ultimate argument, right? How much are we going to see some sort of reduction in the pace of price increases, leading to the Fed to come back and rescue sentiment?
Bond market's loving it anyway. 30-year auction yesterday, massive demand, terrific demand. 30s down to 473. Kelsey, Berro of JPMorgan on with us just moments ago, talking about the bull flattening you're seeing, not just in America, but elsewhere in places like Japan.
I thought that you really nailed it, this idea that stock investors are, oh my gosh, my hair's on fire, and bond investors are saying, we're doing just fine. So please, welcome. It is an international story. It is a question of what's going on with respect to fiscal policy in Japan, certainty around the political backdrop, as much as it is about anything in the United States. Nonetheless, the relative calm that you're seeing in fixed income belies the chaos that you're seeing in specific names. And you're also seeing this in credit. Is that because it is more inured to some of those threats? Is it because people just like the coupon payments? Or is it because it's smarter money that's looking past this and saying, guys, get your act together. The algorithmic traders really need to just deal with their portfolios and let's move on.
Well, you're seeing calm in equities too. At the index level.
Correct.
At the index level, the moves are really muted. 2% away from record highs, just about unchanged on the year so far. At the individual stock level, these moves are absolutely wild. In fact, they're so wild, they're things you would associate with a bear market. You'd expect this stock market at the index level, based on these moves, to be down somewhere between 10 and 20%. That's not happening.
Which is the reason why Jonathan Krinsky of BTIG is saying maybe we're getting to the point where suddenly it's going to have an index level ramification. The NASDAQ has seen 5 days in the past 10 being down more than 1%, right? I mean, if you take a look, there is some real churn there that is leading to a downdraft, particularly in tech stocks. How long this can last and whether this is just superstitious on this Friday, the 13th, we shall see. And I think that our next guest has something to say about that.
Yeah, he's got a much better view, more constructive view of things. I just got this note from SocGen just seconds ago. Speculative trades all unwinding altogether. That's kind of been the story. It's not just in equities, in precious metals. You've seen it in crypto and Bitcoin. You've seen this across the board.
You know, it does feel like there are a bunch of big funds unwinding. Let's just be clear. It seems like there's a lot of selling of gold to try to cover those shorts. It does seem like a lot of the momentum trades are just getting whipsawed around. I want to see this when the dust clears, who the winners are, who the losers are, and who was it who started each of the different rumors of which different AI trade is going to...
See this karaoke company?
Exactly.
They're doing something fresh now. Check it out.
Algorithm.
Amazing.
Rhyme.
Amazing.
Yeah.
By the way, I'm short.
Yeah, exactly. I mean, honestly, there's a lot of stuff going on under the surface. I'm looking forward to finding out more.
Stocks negative by 0.2%. The data 26 minutes away. Coming up this hour, we'll catch up with Jonathan Golub of Seaport as equities struggle for stability. Republican Senator Thom Tillis as the Trump administration tests transatlantic relations, and Tiffany Wilding of Pimco as markets brace for a new inflation print. We begin this hour with stocks sliding on growing AI fears. Jonathan Golub of Seaport writing the following. While AI will clearly disrupt the software space and other parts of the economy, we see recent declines as a buying opportunity. Jonathan joins us now for more. Jonathan, good morning.
Good morning.
You published in the last hour a stronger economy. You're pushing back. You said this. It has become quite in vogue to talk about how punk the economy is. Weak job growth, deficit spending, Labour taking less of GDP. However, from the market's perspective, you believe the incoming data looks, dare we say, pretty darn good. How good?
My favorite part of the Bloomberg terminal is this function called ECFC, where you get to look at economic forecasts. The GDP forecast for the fourth quarter, first quarter, second quarter, and third quarter, all four of them are up 50 basis points since the beginning of the year. That's economic out. And this is not, you say like, well, everybody thinks things are going to be worse. Economists believe that that the outlook is better. And by the way, between mid-year last year and the end of the year, you also had a 50 or 60 basis point move up in expectations. If you look at economic surprise data, since July, across the board, data is coming in better than we would have expected. You're looking at, and you guys are debating, is inflation going to be 10 basis points higher or lower? Since August, inflation has fallen 50 basis points. The jobs, the unemployment rate, 2 months in a row, the unemployment rate came down. I mean, we can go on and on. The ISM, we've had a great market run with the ISM below 50. And now the ISM has popped. The ISM new orders, which is the stuff which is the most forward-looking, is over 57. I mean, this could not be a better story. And Lisa's always nervous about something, but still,
don't take it out on Bramo. Banks are down 6% this week. Staples are up and Walmart has a 50 PE. You've got to respect the price action. So that's your view of the economy. I've got all of that. But why are banks down and utility and the likes of Staples sky high?
But if you look at the market, which is really strange, if this was, first of all, you start with the point that, and you're right, the market's flat and you have a lot of rotation. If there was really fear, the market would be down and tech would be leading. However, if you look at the things that are leading, it's not only defensives. I mean, industrials are on fire year to date. Energy materials look really good. Tell me a time where the market is panicking and it's moving into staples and industrials at the same time by roughly the same amount. It's almost as if the market is saying I want to shoot a bunch of AI losers, whatever those are, and I don't know what to do with the rest. I'm just going to put it in a bunch of other stuff, undifferentiated.
If you're going to be nervous about something, and sure, yes, I can always find something to be nervous about. It is actually a fantastic pastime. But I am curious about your feeling about the labor market and the interplay with some of the AI adoption. We were talking before the show about how you're really bulled up on what AI can do. You're using it a lot. One person can do the work that 25 people used to do, and that's exciting to you. On the flip side, that makes the average Joe or a programmer very nervous because that means they are not necessary and it undermines the economic story. How do you square those two narratives?
This is, I think, and I can't think of another situation going back 100 years where the part of the labor market that is safe are the people who do manual labor. The plumber is not going to be taken out by AI. Somebody who's a farm worker is not going to be taken out by AI. It's the intellectual property worker. It's the lawyer and the accountant and the consultant, which is a very, very different experience, and we don't know how to calibrate it. I can tell you what we're doing. We are finding ways of adding more value with the resources that we have. We are customizing the research product around the needs of an individual because AI allows us to have the infrastructure to do that in a way that 9 months ago, it just was impossible to do.
So don't you understand then why people might say that there are some businesses that might not be necessary anymore if you can do this yourself rather than to outsource it to somebody else? And guess what? Those other 24 people who you could have hired also now are out of work and have to find jobs as a plumber or as a farmer because evidently those are the only jobs available. I mean, at what point do you start saying you can be optimistic about the future, but the price moves are justified?
First of all, we have an unemployment rate in the low fours. The job demand is fine and the economy is healthy. Every time we've had a disruptive economy, if you go back, people were saying the same thing when we started having automated, when you were able to collect your crops using a machine rather than a person, people said, what are we going to do with all these farm workers? It's going to be a disaster. And when we move people to factories to make, your shoes and your clothing, we said, oh my God, what's going to happen to the seamstress? And yet, here we are 100 years later, and we have an economy that's at full employment. We find new and innovative things to do. If you are not able to stay on top of the curve, it is going to be rough for you. So I think that they're going to be losers and winners all over the place. But this fear that in some way that the economy is not okay and that the markets aren't going to be healthy, I think is off.
What should you buy this morning? What are you recommending? What are you advocating for at the moment?
Well, so let me maybe answer the question a little bit differently.
Sure.
If you look at the tech basket relative to the rest of the market, its earnings are on fire. Its multiples are down 20% versus the rest of the market. So I think the tech basket looks incredibly attractive. If there's one group that kind of stands out, it's actually the AI semiconductor names, the Avagos and the Nvidias. If you look at the growth they're delivering, how much the upside revisions are, their numbers, and how inexpensive they are relative to that growth, they look incredibly attractive. I think that there's also a bunch of things in the software space that are dislocated near term, but I think that those big semi names.
The semis was a curious trade last week. It was really interesting to us that we had these announcements, these massive capex intentions. You're all familiar with the numbers, 650 billion across 4 names, and yet we saw semis trade softer. What do you think that was about?
Yeah, I can't answer on a on a given day or week. But I can tell you what we do is we array the entire technology space and we say, where's the momentum in their earnings? And then where's their valuation and what's their price action? And we try to find situations where they can't be justified. You cannot justify the valuations being so low on some of these semi-names for such exceptional growth. And they do not have the same CapEx spend that you do on these hyperscalers.
Would you be buying some of these private credit stocks, the companies, the KKRs, the Apollos that have gotten very beaten up?
It's not in my line of focus. I will tell you, if we get outside of the whole AI conversation, I'll tell you what I think.
There's more to life outside.
Well, maybe not. Yeah, but
being us, he's like, I'll ask the question you should have asked.
I'm sorry.
No, carry on.
The focus this year, especially as we move through the year, is going to be on the midterm elections, which are going to be super important. In order for Republicans to hold both houses of Congress, they're going to need a consumer that is feeling heard. And that means that there's going to be a lot of effort to ease the burden on consumers, to make housing more affordable, to make their basket of goods and services more affordable, and the like. There's the conduit for that is the financials. You have to prop up the banking sector in order to get money in people's hands, and also consumer stocks. I think those are going to be win. I think that the housing sector, housing stocks, home builders and like, are going to be a focus. You've seen the buying of mortgage paper by the GSEs. I think there's going to be more focus on that.
Isn't that a point of tension in your outlook, though? A little contradiction, that you start the conversation by saying the economy's really good, and you finish the conversation by saying it's so bad they're going to have to do these things.
No, I mean, if you looked at where I started the note, labor is taking a smaller part of the overall pie. The inflation number might be down now, but we're still going out on a Saturday night, and the cost of that dinner, people saying, when is it going to come down? We all know it doesn't come down. It just goes up more slowly. They need to feel heard. They need to know that there are things being done to address these affordability issues. And in order to do that, any policy that's going to address that is going to pump up the consumer and consumer stocks.
John, it's good to see you. Thank you, sir. Much brighter, more constructive outlook from Jonathan Golub at Seaport. Blaming Abramowicz for banks being down 6% this week.
Just because I'm genetically nervous does not mean that it's my fault. Let's just put that on the record. I will say that Alpha Generator writes in, I think that he wanted to be heard as well. And I just want to clarify something with private credit stocks. Not to say that it's a monolith either. There will be dispersion there, too. But clearly, it's a sort of PR issue that they have to sort of delineate the good actors from the bad actors, and that's going to be an increasing factor.
Staples up this week, utilities higher by 4%. Quite defensive stuff.
Yeah,
Banks have been hammered.
Yeah.
If you looked at that, you would just say that that's like a recession trade coming on the radar, on the horizon over the last week.
Yeah, and you look at some of the stories that are getting the most attention. It's the delinquency rates going up across the board. It's this concern about the challenger job cuts and things of that nature. So very much a tilt that's similar to my nervous genetic predisposition.
Inflation data, 60 minutes away. Don't apologise, Bramo. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief. Anthropic raising $30 billion in its latest funding round, lifting the firm's valuation to $380 billion, making it one of the world's largest private companies. Elsewhere, Applied Materials shares surging in the pre-market. The largest US supplier of chip-making gear delivering an upbeat sales forecast, signalling strong demand for AI despite recent volatility. That stock is up by 10%. And finally, New York and New Jersey expecting the federal government to unfreeze funds for the Hudson River Gateway Tunnel project. The project's developer expecting over $200 million to be reimbursed. The project still needs clarity on federal funding going forward. And that is your Bloomberg brief. Up next, the morning calls, plus Republican Senator Thom Tillis as the US tests the limits of its NATO allies. Plus, we'll also talk to him about the race to confirm Kevin Walsh down in Washington, D.C. An update on the other side. From New York City this morning, good morning.
If I say that this is going to come for you no matter what, it's difficult to say, no, it isn't, and this is why. And I think that this is the biggest problem, is really trying to understand exactly what the technology is displacing. Because are people going to be comfortable listening to only AI and not talking to any people, which is the direction that right now that the market is going.
That was Sarah Hunt of Alpine Saxon Woods joining the program a little bit earlier. Here's the direction the market's going in this morning. Down, lower by a third of 1% on the S&P. On the Nasdaq was softer by 0.4. That's the price action. Let's get you some morning calls. First up, HSBC cutting its price target on Adobe to 302, highlighting competitive risk from AI-powered tools. Elsewhere, UBS upgrading Rivian to neutral, saying the firm remains excited about the EV maker's product pipeline. And finally, KeyBank raising its price target on Walmart to 145, citing higher tax refunds and easier monetary policy. That name's still down by 0.2% after a monster rally. One more name for you in the pre-market. Alibaba just fell out of bed. It's down by 4 to 5% in the pre-market. This coming from Reuters, that the Trump administration is expected to add Alibaba to a list of firms that allegedly help China's military. That headline just crossed on Bloomberg just seconds ago.
Yeah, and the significance of this and the reason why there's such a knee-jerk reaction in the ADRs is that there are procurement bans with respect to contracts in the United States for some of the companies that are put on lists like this, lobbying restrictions, investment prohibitions, financial and trade restrictions. So there are a whole host of consequences that can come along with a designation like this.
Let's keep it on the geopolitics. Global leaders gathering at the Munich Security Conference. The U.S. Secretary of State Marco Rubio leading a delegation as the Trump administration pushes transatlantic ties potentially to their limits. The Republican Senator Thom Tillis is on the ground in Munich, and he joins us now for more. Senator, welcome back to the program. Forgive me for doing this live in the moment, but the news just crossed. This is on Alibaba, reporting from Reuters that the Trump administration is expected to add Alibaba to a list of firms that allegedly help China's military. This according to reports just moments ago. Senator, clearly the U.S. administration, and Congress for that matter, is looking to put a bit of a squeeze on China. Landing in Europe, in Munich, Germany, do you believe that you have the Europeans on side in this effort?
I think we do, but let's go back to Alibaba. And honestly, any business that's domiciled in China, does anybody really believe that there's separation between the CCCP and the state-owned enterprises and other supposedly independent businesses? I think the president is on the right track to make sure that we're starting to hold China accountable. We need a good relationship with them, but it needs to be one that's founded on trust. And quite honestly, there are moves in China that I don't trust.
So, Senator, with that in mind, should U.S.-based investors be able to have access to investing in these companies?
Well, look, I've got a real problem with we had a banking committee meeting yesterday with Atkins before from the SEC, and I've got a real problem with the U.S. getting into a trend of buying into some of our companies. I feel like we should let the free market really drive innovation. And also back to the segment before, I watched your prior segment. We've also got to unleash AI. We can't be afraid of it. We have to embrace it. We have to leverage it. And we have to be the leader in innovating in it.
Well, Senator, let's talk about that. Creative destruction is a feature of the U.S. economy, and American dynamism is something Lisa was talking about earlier on this morning. Senator, I feel like there's an aversion to that these days and a fear associated with some of the headlines we've all seen over the past week, the prospect of white-collar jobs being wiped out. How do we prepare for a moment like that and ensure that what globalization did to manufacturing doesn't happen to services with AI?
Well, we have to be ever watchful, but the bell has been rung. We can either decide to be the innovation leader and work with our partners and allies, the nations that we have military alliances with, to make sure that the Western world is still in the front of it. But I'm reminded of books that I read about the Industrial Revolution, and any time that we've had a major leap in technology, we can't pretend like it didn't happen. We have to figure out how to master it and be the best practice in executing it and dealing with all the potential negative consequences and job displacement. I think the jury's still out on what the net job displacement is going to be. Does it mean that we've got to put more money in education and retooling expertise around the needs of the AI future? Probably, almost certainly, but we shouldn't resist it. We should make sure that we get rid of the patchwork of laws that are being implemented at the state level that are impediments to our own indigenous innovation in AI, come up with rules of the road at a federal level, and just unleash the power of the U.S. innovation economy to lead the world and get it right.
Senator, do you feel like internationally there's the same skepticism? You're in Europe. It's known for regulating. They're experts in it. And it seems like a growing number of people feel like that is hampering some of the progress. I mean, is there the same kind of enthusiasm? What's the mood like around some of the AI story that's causing a lot of volatility, certainly here in the United States?
For years, I've been trying to remind everyone of how critical we were of the GDPR, data privacy, data breach policies that the EU implemented. They made mistakes. They corrected some of them. But then states started gold-plating some of those policies, California and other ones, that are, again, impediments to our tech sector. What we need are national rules. This is clearly interstate commerce. We need to preempt these laws, make them better. If we find a best practice, be instructed by that at some state level. But we need to set that platform right, or the malign uses of AI are going to outpace our ability to stay up with them. That's why I think it's so important. I was the only one, actually. 99 members voted against it. There was an amendment last year to try and preempt the AI laws at the state level, come up with a national standard. I think that we need to do that very quickly, and we should throw data privacy, data breach in there so that we get it right, and maybe we have a gold-plated standard that Europe can be instructed by.
In the meantime, as people are concerned about this labor market transition and the pain that could come alongside it, it's one reason why there's been so much focus on the Federal Reserve. It's one reason why people are saying it might behoove the Fed to cut rates more aggressively in order to ease the pain for a number of individuals that otherwise might be losing their job. I mean, how much are you feeling satisfied in the process that you could get a hearing for the nominee, Kevin Warsh, in the not-so-distant future? Do you think that that's feasible?
Well, we could have a hearing all we want, but until the investigation is done, I still believe that the initial inquiry and the investigation was a flex to try and get the current chair to step aside. Chair Powell has a term as chair that expires in May. He also has a term that could extend for 2 more years. I have no intention of allowing any Fed board nominee to move forward out of committee and to be confirmed until this matter is settled. Look, this is foundational to Fed independence, and I, for one, am going to stand on the side of certainty, and Fed independence is what delivers certainty in our markets.
So, Senator, it's intriguing because we heard from the Treasury Secretary earlier on this morning, speaking to the American press, and he said the following, that I spoke with Republican senators early this week, and I think we have agreement to go ahead with the Warsh hearing. Do you have an understanding of where he's getting that impression from?
Well, you know, I've said that if they that they shouldn't confuse or conflate two issues. The suggestion that we should have an oversight hearing to see how well this building project with the Fed has gone is fine with me. In fact, I think we should have that kind of oversight for the East Wing construction, the upfit of the Air Force One that's kind of a mini Air Force One because it can't fly out of U.S. borders. All of that is just good governance oversight. None of that has anything to do with an investigation that I believe was dead on arrival. We are talking about 2 minutes of testimony that 7 members of the Banking Committee, Republican members, including the chair, have all said did not constitute a crime. We've got a prosecutor who's not listening to the eyewitnesses and continuing. That's not productive, and I'm not going to allow it. Maybe they can convince a Democrat to vote with them, but as long as I'm the deciding vote, we can have Mr. Warsh, who I would love to be the next Fed chair. But I'm not going to confirm the next Fed chair until I can be absolutely certain that these sorts of flexes do not always have members of the Federal Reserve Board or the chair looking over their shoulder wondering when they get the call from some U.S. attorney with a dream.
Senator, have you had the call from Treasury or from the White House about this? When was the last time you had the conversation on the issue?
Well, I've had a conversation with the American people in C-SPAN yesterday on the floor, and I don't think I was mincing words. I'm not really known for that, but if I need to make it very clear, this is about an end or a resolution. I'll give the prosecutor the benefit of the doubt. Provide me with evidence beyond the 2 minutes of testimony in the committee that 7 Republican members said it was not criminal, it was not misleading, and that there was no criminal intent. it's like an indictment looking for a crime. And to me, it's at the edge of absurdity that I can't accept. The only thing I know that I can do is exercise my right as an individual senator to hold up future nominations until this investigation's done. But to the assistant U.S. attorney, bring me evidence beyond the 2 minutes has been rejected out of hand by the majority of Republican members on the committee, or prove to me that there's been an instance where a referral. What's really odd about this, and I spoke about this on the Senate floor yesterday, this is the first time that I can find where a prosecutor moves forward with an investigation without a referral from the chair or a member of the committee. Maybe somebody can prove me wrong, but if that prosecutor has compelling information, either the way they read that 2 minutes or something else that no one's aware of, let me see it.
Senator, before you go, time for one final question. You're in Munich. Let's finish where we started. Chancellor Merz just spoke moments ago and said the transatlantic partnership is no longer self-evident. Senator, how well received was your delegation in Munich?
Well, you know, we're going to have, I think we're going to have a lively discussion here. I had someone ask me about J.D. Vance's, Vice President Vance's speech last year. I said that I wouldn't have given that speech, but I would not have missed the opportunity to let my family of nations in NATO know that one of the reasons we're here is because of the $2 trillion deficit over 20 years. Jonathan, can you imagine how much more ready we could be if all the demand signals that would have come from $2 trillion in weapons and our mutual defense had actually been purchased by the countries of NATO who have failed to even meet their minimum requirement? So I think there's frustration there that we need to get past. But I am speaking, I believe, for the majority of Congress who knows that the NATO alliance is the most profound and impactful alliance in the history of mankind, and we stand behind it, and we will as we go through this discussion to get things back to normal.
Senator, appreciate your time. I know it's loud over there. Enjoy Europe. Thank you very much, sir. Senator Thom Tillis there on the Federal Reserve, on China and the relationship with the Europeans. Just ahead of CPI data, if you're just joining us, welcome to the programme. Equities at the moment into that data just a little bit softer, negative by 0.2% on the S&P, on the Nasdaq down by a third. New problem for tech stocks. This time it's Chinese tech stocks. That headline on Alibaba 15 minutes ago.
Yeah, coming out and saying that the U.S. is looking at Alibaba as cooperating with the Chinese military. And Senator Tillis right there was saying, of course they are. I mean, how can you really extricate these? But designation like that has serious market implications. And that's the reason why those shares are so much lower.
That stock is down by about 4%. With the CPI data, month over month, year over year, and including core. Let's cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. The numbers just starting to drop here, and they are a little bit better than what economists expected. A 0.2 rise in the CPI headline, which puts us at 2.4%, down from 2.7% on an annual basis. The 2.7% was for December. Remember, there's some things you got to think about with these numbers because of the fact that we didn't have any October numbers, and that biases all of this. Core CPI comes in up 0.3. That's more than the December 0.2, but it's what the market had forecast. On a year-over-year basis, we're up 2.5%. That's down 0.1 from 2.6% in December. So a little bit better news there overall for the markets, but still, when you look at the core numbers, you're not getting a whole lot of progress. We're looking here at the food price numbers. They were up in December by 0.7. So we have to see here we get the updated numbers for January. Food prices just rose by 0.2 during the month. Food at home by 0.2. Big drops down from what we saw in December. Gasoline prices were down 3.2%. That's a big weight on all of these numbers. And used cars down 1.8%. New cars up just 0.1%. And apparel prices up 0.3%, same as the month before. So a lot of the big contributors to CPI coming in softer than anticipated. And you can see why we see the headline number come in a little softer than economists had expected.
Mike McKee will take that. Thanks for the update. Appreciate it. Stay close. Downside surprise then, small one on headline CPI, 0.2% month over month. The survey was 0.3. Our survey here at Bloomberg, the median estimate for core was 0.3, in line at 0.3. I guess that's good news. Push it through the bond market. Yields drop at the front end of the curve. We opened this week at 350. We pushed higher off the back of hotter than expected payrolls. And then this morning we're down again by 4 basis points, 341 at the front end of the curve. Further out along the curve, 10s with a break of 410. Yields down by 2 basis points on the session now at 4.07, and basically at the lows for the year, Lisa, on a 10-year maturity following that softer than expected CPI print.
Okay, 0.1% on this CPI print allowed a rally in the bond market that has taken two-year yields down by about 10 basis points in 1 week. After getting a jobs number that was significantly higher than the expectation of 130,000 jobs created in the prior month. You put this together and you understand the confusion that people have. Somehow people are saying that this inflation rate, given the fact that apparel prices didn't increase that much, that the used car market was a little sluggish, gives the Fed the green light to go ahead and cut rates by 2 or 3 times in 2026.
It keeps the Fed put alive.
Yes.
I won't talk about the scale of the move because it's fading as I look at it right now. And as we often say, following the data, the first move isn't always the right move, and that might hold here too. But with regards to the move that we are seeing directionally, keeps the Fed put alive. That if you do get the material weakness in the economy, you're not going to get the pushback on the committee as Kevin Walsh takes over, if you keep getting prints like that one.
Yeah, right now you're seeing two-year yields at the lowest levels going back to September of 2022 and dropping. So even if you do get something of a knee-jerk reaction that does fade, there still is a feeling that the door is open. And I could say that politically the door is certainly open, but the numbers that we saw in terms of the labor market also seem to justify it, especially adding to some of the concerns that we see in the AI trade. So interesting to see how big this move is, how biased people are to look to that Fed for some sort of response.
Just heard from Senator Thom Tillis, and the door is closed for the hearing for Kevin Walsh. Still got to talk about that, you know, the timing. It's a matter of if, right? It's a matter of when, rather, and not if, because ultimately Kevin Walsh is going to become the next Fed chair. You heard Senator Thom Tillis. He's going to vote for him. He likes the guy. But it's a matter of when still. And it's going to take some time. It's going to take some time.
It's fascinating to see Scott Bessent on the American airwaves earlier this morning, as you say, talking about how they're getting close, and then to hear Thom Tillis saying absolutely not, closing the door on that.
What's giving him that impression that they're going to get the hearing?
I think that
the hearing will proceed.
Hopes and dreams. I mean, how much is there actually motion on the other side to potentially resolve this legal issue?
Tiffany Wellinger, Pimco, joins us now, not to talk about that, but to talk about the data. Tiffany, welcome to the programme. How much weight can we put on this week's data? Hotter than expected payrolls, softer than expected CPI.
Well, I think this morning's inflation print, even though it was in line with the Bloomberg consensus expectations, was actually pretty encouraging under the surface. You know, I think there's two things that we would highlight in that regard. You know, one is just that shelter inflation, which had been stubbornly, just persistent since the pandemic, it's finally really decelerating. And we saw that in today's report. You know, rental dynamics for new tenant rents actually suggest that you're seeing a pretty stagnant rental market, and that will ultimately feed into OER with a lag. So that's good news for the Fed. I think the other good news in this report, is that the tariff-related effects are largely fading. So we probably did get a little bit of a bounce back in core goods prices, retail goods prices from the discounting that happened over the holiday season. But ultimately it looks like tariff effects have they're behind us at this point. They were passed through to the extent that companies were going to do it. So as that fades, you should have a Federal Reserve that feels more comfortable, cutting interest rates. It does look like they are a little bit restrictive relative to the median long-term estimate of the long-run neutral interest rate. So getting a couple of more cuts in this year seems very reasonable to us.
Tiffany, not all rate cuts are created equally. Do you see then a Federal Reserve that's cutting interest rates because inflation gives them the space, or because the labour market gives them a reason?
So I think so for us, the outlook for the labor market is pretty stable here. Ultimately, we think growth is going to be OK this year. We're looking for 2%. That should support the labor market. But nevertheless, you do have this AI-related adjustment that's happening, under the surface. So, those factors are sort of offsetting. We're looking for the unemployment rate to kind of stay where it is. And then outside of that, we're looking for inflation to moderate back to target this year. So that, in our view, would be consistent with the Fed that's easing somewhat. Of course, if the unemployment rate were to rise much more, then that would warrant more easing from the Fed.
Tiffany, do you think that this actually opens the door to 3 rate cuts this year, as the market seems to be implying right now?
Yeah, we'll definitely have to see. It's certainly possible that they could get in 3. Again, I think as kind of a rough estimate, we're looking at the midpoint of the long run neutral estimate, which is right around 3%. They're at 3.5 now, so that implies 2 more cuts. I think getting another one in would, be the result of more disinflationary pressure, potentially below target inflation, or the unemployment rate moving up.
I understand the idea of celebrating disinflation. We're still at 2.4% year over year for CPI, and people are saying this is winning. How strong is the disinflationary force coming from the housing sector that gives you confidence that we're actually going to get down to 2%, even with Fed rate cuts, given that we've been above 2% for 5 years?
Yeah, the housing sector has certainly been one of the reasons why that we've had stickier inflation. So the housing OER and rental inflation have been incredibly sticky. That's in part because of it just takes them longer to adjust. So they didn't accelerate as much as home prices did during the pandemic, but now they're decelerating at a slower pace. That's finally over. It looks like that catch-up has happened in the rental market, and you're now seeing more stagnant rental trends. So that is important. But again, the other thing is that the thing that's held up overall inflation over the last year is some pass-through of the additional costs that companies have to pay as a result of tariffs. But that's a one-time price level adjustment. And when we look at core goods price behavior, it looks like that adjustment's largely happened. So now that it's happened, you should see core goods, price inflation also starting to decelerate. So again, all that is good news for the Fed.
Tiffany, just one final comment, if we can, on the committee that Kevin Walsh will ultimately at some point this year be taking over. How contentious will things be? How divided is that committee currently?
Well, I think you want to look at where everybody is, where everybody's sort of writing down where they think the long-run neutral interest rate is, because that's going to be the debate this year, we think. And of course the AI, and the technology related to fusion will have implications for that R-star debate. But there's a good majority of the committee that still thinks that the current policy rate is above their estimate of R-star, which means policy is slightly restrictive. And if you have employment that is consistent with maximum levels and you have inflation that's running at target, you should be at neutral policy. And so again, the real debate this year on the Fed is where neutral policy is going to be. And again, we're kind of looking at the midpoint of their estimated range of 3%.
Tiffany, appreciate you jumping on. Thank you. Tiffany Welding there of Pimco. If you're just joining us, welcome to the programme. CPI out 10 minutes ago. Downside surprise, 0.2%. The estimate 0.3. That's headline on core. Core CPI coming in at 0.3, the estimate 0.3. Unlocking some gains off the lows in the equity market on the S&P. A bit of outperformance down the Russell, small caps higher by a third of 1% with the repricing at the front end of the curve. Yields coming in just a touch. They were down 4 or 5 basis points at the very front end of the curve. Lisa, we're now down 2 to 343.
Yeah, although you are seeing a 50% chance currently getting priced into the market in terms of Fed funds futures of a Fed rate cut, a third Fed rate cut for this year. But I like how you pointed out that core did not change. It was bang on line. And if you're looking at where the disinflation is coming from, yes, it's coming from retail, and yes, it's coming from potentially used cars, but it's also coming from gasoline. And that is one of the volatile factors that could turn around because of some of the oil price gains that we've seen of late.
In this market, in line is good news.
Evidently.
Let's just go with in line and, good news.
We've been too negative. I think this is great. I'm embracing the disinflation, and so too is the market.
You're just getting close to the weekend, 20 minutes away. You know what this is about. Mike McKee's still with us. He's standing by. Mike, you're looking for the details. What jumps out for you? Is this a good print?
I wouldn't go so far as to say I would trade on more Fed rate cuts because of this. There are some signs in here that are a little concerning. Goods prices were flat, and a lot of that has to do with, as Lisa said, used cars and gasoline. Services prices were up 0.4, and then underneath the hood, you see tariff effects. You do see them. We see household furnishings up 0.7, appliances and laundry materials, washing machines up 1.3%, video and audio equipment up 2.2%, computers and software up 3.1%, and these are month-over-month gains. So we are seeing companies start to roll out price increases on things that have been tariffed. Now, the question is this a one-time thing, which is what Chris Waller has been arguing, or is it, as others in the Fed have been concerned about, something that's going to keep prices going up for a little bit? When you look at Supercore, take out housing, and Tiffany mentioned how housing had gone down, it's still up 0.6% on the month. So we are seeing prices rise for things. And remember, this is CPI. There was no October CPI. The Labor Department put that down as a 0 for the month. So CPI is biased lower. Next week we get PCE for December. And according to the Bloomberg survey, that's going to go up to 3%. And a 3% handle is not something on PCE, which is the Fed's target, that the Fed is going to want to build a case for cutting rates on.
Yeah, the hawks of the Fed aren't going to like that. Mike, thank you, sir. Mike McKee, can't get away from the gloom. You tried, and Mike just brings you back in.
I'm just depressed now.
Right.
I don't know how. I mean, he's got some good points there, particularly about gasoline, because gasoline's inflected upward, seeing tariff pressures. Nonetheless, that housing component, do we really believe that? Are we measuring it correctly? So that's where I'm going to get my optimism. Rents have been stabilizing.
You're not alone. That's where a lot of pushback comes with regards to the official data. Equity still just about positive, up by 0.1% on the S&P. Outperformance on the small caps, the Russell, up by 0.4. In this market, anything could change in the next 5 minutes or so. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Recapping the data, inflation coming in cooler than expected, rising 0.2% compared to estimates of 0.3. Core inflation coming in line with estimates. Elsewhere, Alibaba shares falling in the pre-market. Reuters reporting the Trump administration expects to add the company to a list of firms helping China's military. According to the report, the list doesn't impose sanctions. It signals White House concerns about the company. And finally, Rivian shares soaring in the pre-market. The EV maker surprising investors with strong fourth quarter results and its first ever annual gross profit after years of consistent losses. Their stock is higher by 26%. And that is your Bloomberg Brief. Up next on the programme, Jim Caron and Morgan Stanley. With inflation coming in cooler than expected, plus Danny has your morning movers. Wendy's shares falling as the company struggles to keep value-focused customers. That stock is down by more than 4%.
If we're reasonably comfortable that core inflation is running down more at 2.5%, I think that's a pretty comfortable place to be reducing policy rates. The numbers are imprecise, and there are issues in terms of just measuring inflation. So if you're at 2.5%, you're basically at your target. We should be seeing that kind of upward pressure on goods inflation fading, but that's a key question.
That was Andrew Hollenhorst of Citi weighing in on the inflation story. Inflation coming in a little bit softer than expected this morning, only moments ago, unlocking some gains and a move off the lows on the equity market. On the S&P 500 this morning, just about unchanged. On the Nasdaq, slightly negative. We have gone 3 days on the S&P 500 without gains. Can we avoid going day 4 into a long weekend stateside? Let's get you some morning movers, some single names with more. Here's Danny Berger. Hey, Danny.
Hey, John. Not all fast food is created equal. Earlier this week, we learned that McDonald's had strong earnings. It is not the same for Wendy's. They disappointed not only on their fourth quarter, but their outlook, too. They also said they're going to be closing something like 5 to 6% of stores. We know McDonald's cut prices drastically to bring people into a value offering. Perhaps Wendy's has some catching up to do, shares down 4%. The flip side of this trade is the grocery trade, and that seems to be going well, although maybe not going into store. Maybe everyone's lazy like me and orders them. Instacart shares up 13%. They beat across the board. The CEO saying that their retention of customers in 2025 was akin to their peak in 2023. So those shares, again, up 13.4%. Finally, some breaking news in the past few minutes. The Pentagon confirming that they have indeed added Alibaba to a list of Chinese companies allegedly helping the Chinese military. Now, there aren't necessarily sanctions that automatically come with this, but it puts them on a watch list. Shares, the ADRs of which falling 4.2% this morning, John.
Hey, Danny, thank you. Looking forward to the programme in about 10 minutes' time. Not just Alibaba, this from the Pentagon. Headline just crossing the Bloomberg terminal. Baidu, BYD, Alibaba aiding the Chinese military. BYD's an interesting one. And that'll be an interesting conversation with the Canadians later on this year, won't it?
Oh, especially given how they have been increasingly leaning into that. And one of the concessions potentially to renew USMCA has to do with potentially increasing pressure on Chinese goods by Canada. Also interesting, over in the Munich Security Conference, I'm curious to see what Europe says about some of these measures.
Let's bring in Jim Caron of Morgan Stanley. Jim joins us following inflation coming in cooler than expected just moments ago. Jim, welcome to the programme. Is that enough to stabilise this market, or is it going to be difficult to put a lid on this volatility?
Okay. So I don't know if the inflation number necessarily does it. It is a good sign that we're having higher productivity, and it's part of the bigger picture story of better productivity, better growth, inflation's not rising. The larger picture is still a positive picture for the markets. We're having decent growth. But Jonathan, there are two words that we have to focus on right now: contagion and dispersion. We are going through a repricing of a segment of the markets, which is a software sector. And there's worry that this might create an event that is contagion for the rest of the markets, and that creates, some type of a bigger move down. The other question that we have to answer is there dispersion? Can you diversify these risks away? So far, what we're seeing is that a lot of the risk is concentrated in one segment of the market, right, which is the software sector. It's a question about leverage, and that's primarily in the private markets, primarily in the private credit space. But you're not seeing it in the publicly traded fixed income markets, right? High yield software is only about 3% of the high yield market, has a relatively high quality at this point because a lot of those bigger risks were dispersed and diversified into the private markets. So the ability for this to create contagion and become a bigger financial event, I think, is relatively low. It doesn't mean that people aren't worried about debt refinancing for the software sector and what that might mean for equities and things like that. But I don't see this as a liquidity event like your typical, market moving, big, substantial market moving event. I see this as a repricing in a segment of the marketplace that people are trying to get a handle on and trying to see if they can diversify the risks.
In the meantime, Jim, they're hiding in the same places. They're going to places like Staples and sitting in Walmart, going into earnings next week. What's your advice for the people piling into that trade?
Well, look, one of our calls for this year was a cyclical broadening of the markets. So, for the past couple of years, we've been talking about the Mag 7 and people forgot about the other 493. So the way that we see it is whether it's materials, whether it's industrials, or it's even some of the financials. Some of the financials right now are actually looking, pretty interesting just given the recent downdraft. And I think it's a good buying opportunity. My advice is that there's a lot of creative destruction that's taking place in markets today. And AI is chiefly responsible for that. But it also means that there's a lot of companies in the more traditional value sectors of the markets that are going to be the AI beneficiaries. We can't forget about that. And these are the companies, if they employ technology well, are going to create the economic value, and we're going to see higher gains out of industrials. Look at stocks like Caterpillar, for example, right? Very, very strong, very old school, traditional company. These are the areas that, as a portfolio manager, as an investor, it's a very diverse market where we can create a lot of diversification. This is a great opportunity to think about being a stock picker and a bond picker as opposed to just a passive investor.
Jim, you said something very interesting there, as they employ technology. And they're employing technology, not necessarily humans, which is the reason why people are very concerned about the labor market right now. And I wonder, as you say, it will all come out in the wash, which is very wonderful, that you think that ultimately some of this broadening out is predicated on a series of rate cuts. Is that true?
I don't know if it's necessarily predicated on the rate cuts, but the broadening out, what we have to recognize here, it's a broadening out of the labor force too. So what we've seen really since 2001, so if we go back a few decades, is that the capital share of GDP had done really, really well, where the labor share of GDP had done very poorly. Now what we're seeing with a rebirth of maybe some of the manufacturing, some of the cyclical broadening that we're seeing, is that more of the labor share of GDP is doing better. So yes, there might be some unemployment in some of the white-collar technology jobs, but try to find an electrician. Try to find a plumber, try to find a carpenter, try to find a welder, right? These are the segments of the economy that is really just not spoken about enough, that are actually really, really strong. The demand for labor in those spaces, and those are higher paying jobs. Those are trades. Those aren't service sector jobs, right? Those aren't like, very low end service sector jobs. These are very high skilled labor jobs that are coming back. That's the other part of the economy that I don't think that Wall Street spends enough time talking about.
Hey, Jim, I hate to end the conversation there, but we're actually out of time. And we will find time to talk about that next time you're on. Jim, thank you. Jim Caron of Morgan Stanley there. Jim pushing back against the prospect of financial contagion risk. Some pushback from Jim.
Yeah, he's going back to the Steve Rashuto point. It looks good. It sounds good. It is good. And that seems to be what a lot of the bulls are. Right now, I'm just looking to see, how do I become a plumber? It's a 4 to 5 year apprenticeship. So it's a lot of work, and you have to have good physical stamina, and you have to have a good sense of where things are in terms of mechanics, which might be a problem.
Do you have a good week? Do you enjoy this?
It's actually fascinating. This is a fascinating moment. I did.
It's a fascinating moment. Enjoy the long weekend. You've all earned it. From New York City this morning, good morning. This was Bloomberg Surveillance.